stock because it's their new super hit Zenic, which has got a nod and will go into second phase of clinical trials. In fact, we spoke exclusively with Wockhardt chairman Habil Khorakiwala on this wonder drug Zenic. Listen in.
We have just completed phase 3 clinical trial, and this clinical trial establishes Zenic is a superior treatment, which is very rare happening in antibiotic or any drugs. Second is that we should be expecting this drug to launch in India by early next year, and in US maybe middle of next year, because we will be filing in US sometime in middle of this year, and then we expect sometime in the middle of next year to receive approval.
All right, now to our budget masters who are with us in the studio and will be with us through the budget speech and will tell us, based on their expectations that they'll lay out right now, how did the budget fare, if you will. Pranav Sehta, National Leader, International Tax and Transaction Services, EY. Mihir Vora, CIO of Trust Mutual Fund. Both of them with us in the studios. Gentlemen, both of you, thank you so much for joining in. Really appreciate your time. There was a hot debate around what is it that the budget can do within the limited space does it have. Can it overshoot the fiscal deficit target a little bit in order to spur capex demand, etc.? Mihir, initial thoughts.
See, I think there is limited, space for the government to maneuver, especially given the fact that we need to balance investments and infrastructure, etc., versus boosting consumption. So there is a fine balance to be maintained. The good thing is that, at least from the stock market point of view, till say the middle of yesterday, there wasn't much of expectations. Markets have been kind of discounting a lot of slowdown, etc. And just because the Prime Minister made some good comments on the middle class, there was a bit of expectation. But apart from that, I don't think we are going in with too many expectations in the budget. So no bad news will be good news, I would say. Okay. In the budget, and anything else will be a bonus.
I find this interesting. So you're linking that comment. And, if you have that soundbite, we should quickly play it as well, where Prime Minister talked about how, Goddess Lakshmi will shower her blessings on the middle class as a kind of trigger for the market, that there is going to be a big boost for consumption. Is that the biggest ask right now, Mihir?
I think that's not the biggest ask, because as far as consumption is concerned, for the rural masses, states are already doing a lot. All the 12 states which have introduced different schemes for women, etc., all put together is already 2 lakh crores of stimulus. They are almost 0.6% of the GDP, which is already being given to women as stimulus. So I think rural-wise, the centre doesn't need to do much in any case.
There are enough of those Ladli, Behna and all those schemes. So
that's almost 2 lakh crores on an annualized basis. So that's a decent stimulus in any case. For the urban middle class, what can be beneficial is you do see some tax breaks, etc., because we are seeing some signs of stress in the urban consumption theme. So anything which boosts sentiment for the urban middle class will be good. But I think more important to see is whether the thrust on central government capex continues, because that's been one of the big drivers of the economy for the last 5 years. We've almost seen 25 to 30% compounded growth in capex spending since 2020, and that's been one of the pillars why we could come over the corona slowdown. I think that still needs to continue because the private sector still hasn't kicked in to the extent required. So a continuation of schemes of government schemes on railways, roads, defence, etc., plus more sectors and larger outlays for the PLI schemes is something that would be more important in my view.
I'm just going to play out that sound clip from Prime Minister, and then we'll ask Pranav Sehta whether there is enough space and what is the possibility of those tax cuts we're all anticipating.
मैं मां लक्ष्मी से प्रार्थना करता हूं कि देश के हर गरीब एवं मध्यम वर्ग समुदाय पर मां लक्ष्मी की विशेष कृपा रहे। साथियों, ये देश की जनता ने मुझे तीसरी बार ये दायित्व दिया है और इस तीसरे कार्यकाल का ये पहला पूर्ण बजट है।
Okay, so a couple of things that we need to talk about. I think on the personal tax front, as well as I would say on indirect taxes, the tariff response as well. So Pranav Sahita, let me start by asking you about the personal tax front and this idea that the boost to consumption can come with some tax tinkering. We've seen, and tinkering is the word, very, very little here and there, which doesn't actually do much for consumption.
Yeah, I think it's more about the sentiment and the expectation than much ahead of that. But I do feel that something will be done in terms of helping the middle class get a little more boost to consumption. May not be very significant in the ultimate analysis on the pocket of the middle class, but still that helps in terms of the sentiment, as well as the fact that the government is thinking about them. And that's, I think, one thing that will happen. I also do feel that to some extent there will be an impetus given to Make in India, maybe through PLI, indirect taxes schemes and so on, or maybe through some amount of restoration of a concessional tax regime on manufacturing. I do hope that comes. Since we are talking of expectations, I do hope that something that comes, because across the world we are seeing an impetus being given to domestic manufacturing and so on. So I do feel that will help to a large extent.
Which sectors do you think there's a possibility of seeing this in?
I would feel that this might be across the board, but at least in sectors which can promote a lot of employment generation or job creation. I think that's one thing that the government will want to focus on, to somehow bring about that animal spirits back again. And unless manufacturing is given that fillip, job creation is not going to be easy given our demographics. So I do hope and feel that that's something that they will also focus on.
Mr. Sahita, good morning, of course, and it's always great having you. All right.
Sure.
Just wondering, one of the problems for the capital markets has been the incessant outflows. Now, taxation changes can't change that. It needs to be economic conditions. Right. But taxation changes at the margin influence whether or not there are enough incentives out there or disincentives to come in or go out, right? Is there anything that you hope, or is there anything that you fear in the budget, fine print or otherwise, that could have a bearing on this?
I hope not. In fact, I do feel that if they maintain the stability, consistency, clarity, and providing certainty, investments will come in. The chief thing here is to ensure that there is ease of doing business. That's, I think, where the second generation of reforms is really required. Because unless, and the economic survey speaks so much about it, deregulation. I think if that's what happens and the government capex on infrastructure keeps up, which over the last 8-10 months has been a little muted, I think those two things, deregulation and providing the right kind of infrastructure, will be the best fillip that one can give to investments, both foreign as well as domestic investors. Otherwise, even Indian businessmen probably will invest more abroad than in India, is what we are seeing these days. So I do feel that that's something that will be very important. One, keeping the regime stable and predictable, which I think the government has done a good job so far and will continue to do that. Second, capex, which has been great over the last few years, but the last 8-10 months have been really very tepid, and that I think needs to pick up, government capex infrastructure building. And third is, as I said, to some extent ensuring that deregulation and the next generation of reforms, for which also I think that taking states along will also be very important and critical. So somehow building that consensus which they built, I think when they brought in GST to a large extent, that consensus building and taking states along, because that's where a lot of the next generation of reforms will have to come as well from, whether it is land, labor, some of the infrastructure and so on and so forth.
That's an important point because in some sense, what states do or don't do has a large bearing right now on how the economy does, because there is a red alert out there on the fiscal health of a lot of states who are doling out freebies currently in order for political compulsions, if you will. So what to your mind is arguably one of the most important things to watch out for from this perspective in the budget, if at all?
See, ease of doing business can't be addressed in the budget. It has to be built, based on consensus and taking the states along. I think, but even more important is how to eliminate the real grassroots level harassments. I think that's a key part of ease of doing business, and that's what needs to be addressed in terms of, I don't know, governance structures or reforms, anti-corruption movement. So in fact, if that improves, I don't even think we need PLI. So PLI essentially directly or indirectly is a cost of or trying to make up for all these inefficiencies at the grassroots level. So I think that would probably require more of a mindset change rather than any thing in the budget or fiscal incentives, I would say.
Yeah, but just to that point, Neeraj, now either you look at subsidies as a red flag or you look at them as a consumption boost, because in the course of this conversation we've ended up looking at it both ways. For now, at least, if that's what's propping up the economy to some extent, wouldn't that at least be a positive from a market's perspective?
See, subsidies are now going to be a global phenomenon in my view.
A global phenomenon,
because I think the end game everywhere is the world, especially the developed countries, are so much deep in debt that the only way out structurally is to inflate their way out of the problems, whether it's the US or Europe, anything, right? Which will mean that you will see asset prices, continue to be high. Inflation will be there structurally as a sticky way, and which will mean that the lower income category, population will have to be directly or indirectly subsidized, whether it's UBI or, as we saw in COVID, the US was giving $1,000 checks to people. I think that will have to continue because inflation is going to be sticky, especially in the places where you have seen so much debt building up. Even, for example, President Trump's measures to, introduce import duties will, initially at least, till the time you have US ramping up its own manufacturing, initially it will be inflationary in nature. So that's going to be a structural issue. As we speak, in the last couple of months, again we have seen food grains, etc., prices go up. FMCG companies already talking about raw material price increases.
Yeah.
So I think inflation is not going to go in a hurry, which means that subsidies will be a structural part of any economy.
No, just on the tariffs bit, and I wanted to get your view, Mr. Saita, because we did a story that we're expecting in this budget a custom duty drop on 7 to 8 items imported from the US. It's, in a sense, perhaps you can look at it as a preemptive move as all of this tariff talk goes on. What does India need to do to be on the right side of this tariff trade war, this global tariff war which is going to erupt?
I would feel that yes, some definitely signals might come along, but primarily anything that we do will be measured. I would feel we would wait for what exactly US comes up with. And I don't think India is on the top of the list of countries which will face the heat of tariffs.
Yeah.
So we would wait, I think, to see how it goes along. But yes, any and every items which are primarily inputs where India is value adding on that and sending out again, particularly, I think that's where we will see definitely tariffs coming down.
I think our fight is not really with the US.
Yeah.
The duties have to be with China, right? Import from China is the bigger one.
Yeah, but just that, I think, so we've done a small exclusive 3-4 days back. It's a very small, tiny item, but 7 or 8 key items from the US might see some bit of duty changes.
Right.
Maybe it's ahead of the Trump-Modi meet or Modi-Trump meet, as the case
Symbolic.
may be. Symbolic in nature, but yeah, something like that to come out at as well. So pretty interesting things that might happen.
Yeah,
Right.
yeah. Ramdev Agarwal joining us on the conversation this morning, Chairman and co-founder of Motilal Oswal Financial Services. Mr. Agarwal, thank you so much for speaking with us here at NDTV Profit. Absolute pleasure on what is turning out to be perhaps an exciting morning, more optimistic than we would have thought at the start of this week.
Hello, yeah. Good morning. So clearly things are kind of evenly balanced, and there's a lot of hope that the FM is going to shower goodies for the middle class and women class. That looks to be what even PM's expectation is. So I would think that the commitment to what you call Viksit Bharat, that's coming out very clearly, and one of the ways to increase the GDP growth rate from say 6.5% to maybe 7.5% would be the giving some kind of incentive to the middle class for consumption. That looks to be the theme right now.
And do you think that that's the single most important perspective? I'm just wondering, on a budget morning, and we're speaking half an hour before the budget, what does a Ramdev Agarwal have on his checklist to look at? Will you be looking at the capex figure, the fiscal deficit figure? What is that top point that you're looking at?
Yeah, so I've noted down 3 points. One is the middle class, what exactly they end up doing for the middle class, and where FM has said, clearly PM knows what exactly is going to come. So his wishes are around middle class and women class and poor. So clearly we are going to see some bundle of measures out there, whether it stands up to anything in the market or not, that's one thing. Second is the commitment to 8% growth, whatever it takes. I mean, it is for the leadership to say that we are committed to 8% year on year. There will always be some cost here and there, but growth solves a lot of problems. So how committed they are, bureaucracy as well as the policymakers and leadership, to 8% thing. Third, the credit flow. I think one of the biggest things which has hurt the economy in last 12 months, in my limited understanding, is the credit flow into the entire economy, which has come down from 15-16% to 10-12%. If we remain at 10-11%, do whatever, I don't think we'll ever touch 6.5%. That's my sense.
Okay. Mr. Agarwal, good morning. Neeraj here. I love the backdrop, budget bullets. Maybe dodge any bullets that might come our way if they do. But here's my question, sir. One of the things that some of the panelists have stated today, of course, the unequivocal focus on growth, and therefore, if the FM and the government, or the FM in her wisdom, decides to deviate a little bit from the fiscal glide path, if that shows an intent to invest for growth or creating demand. So if the next year's number is not 4.5, right, and it says that it is being done to stimulate growth, will the markets take it well, or will the markets be disappointed?
I don't know about the market, but I'll be very happy. In the sense that, to me, growth is paramount, and if you can do fiscal, to me, if you can do the growth and then consolidate fiscally, that will be very good. But I would not put fiscal consolidation as a priority over the growth. Because once growth comes, even fiscal consolidation is possible, because your tax revenues, they get boosted.
Okay, that's one. And something that I'll ask Meer Vora also, but just a follow-up question to that, Mr. Agarwal. We want to do a lot of things. There is very limited resources as well. This time around, we know that this year the revenue picture also has not looked that strong, right? So let's assume the fiscal path is maintained, if you will. There is not, I mean, we haven't done enough capex, and let's assume that number stays as is and doesn't really increase too much, if you will, and therefore misses the budgeted estimates too. Will that be a disappointment, or will that be a need of the hour because revenues also have been lower?
I mean, let's see the actual number, what comes out. My sense is that if they're able to boost the GDP growth and nominal GDP growth rate, even if with a little higher inflation of about, say, 5%, I think they will have enough revenue. And so they will have enough resources if they want to do, if they want to maintain and actually increase nominally the capital expenditure. Because the best place where the capital expenditure will give rewards to the economy is going to be infrastructure, and that only government can do. So clearly the momentum which we are seeing in last few years, where government is coming very aggressively onto the infrastructure side, that momentum should be maintained. And if anything, whatever was the budgetary provision last year, the next year should be somewhat higher, at least 10-12% nominally, so that it may remain percentage of GDP same, but nominal value will be 8-10% higher.
The other piece, Mr. Agarwal, that from a market's perspective, what does it look to? The last few years have seen this unequivocal focus towards creating manufacturing assets, giving PLI schemes, etc. That may well continue. But if there are tax changes or other changes done in order to boost consumption, all right, and boost household income, does it change the texture of the market, in that the market starts rewarding consumption themes, staples, what have you? And is that fair too?
See, Neeraj, actually market is looking for earnings growth. I mean, from whichever sector it comes. It is not necessary from the only consumption side the earnings growth should come. If aggregate earnings growth, which is now flattened from last year 1,000 rupees EPS for Nifty, it has come to about 1,050 for the current year. Next year, if it doesn't scale up to 10-12% from 1,050 to say more like 1,200 or 1,150, I think market will not be excited. So it doesn't matter from which sector it comes, whether it comes from infra side, consumption side, energy side, you take your pick from which side it comes. But my aggregate earnings growth should be more like, I'm speaking as a capital market guy. If my earnings growth next year looks to be, my head of research revises the earnings growth projection for 25-26 to by 12 to 15%, that will be the big day, whether it comes by tax cut, whether it comes by earnings growth, I mean per se top line growth, or margin expansion, that is all. But 12 to 15% earnings growth next year is almost a must to hold the markets at 23,000.
Okay, I'm just on earnings growth, Mr. Agarwal. Want to get your view. Have you, if there's a scale of disappointment or optimism, how are you feeling from what you've seen so far? Because Q3 and second half was supposed to be the better picture being painted. This is what we all heard in the end of Q2. What have been your thoughts when you've seen the earnings growth? Because at the end of the day, budget will go one day affair. After that, you will have Trump doing whatever Trump does. But this is the core number that we need to watch.
Yeah. So clearly last year, thanks, I mean, if you see the economic survey, Mr. Anantharaman has gone about saying that the slowdown is not structural, it's seasonal, in the sense that because of elections, the government capex slowed down, at least in the first 9 months. And that has led to whatever Q3 5.4% or somewhat like that. It's not a structural slowdown in the economy, it is more of a seasonal. And that's why in one of the interviews I heard yesterday, he said, of course in the economic survey is written that their expectation is about 6.3 to 6.8, but he's the guy who is insightful today, because he has written the whole thing. So my sense is his expectation of about 7% for 25-26. I would think that he would be on the right line of thinking. And if that 7% comes with 4.5-5% inflation, I think we'll have good time. I mean, in the sense that corporate earnings will pick up by more than 12 to 15%.
Got it. Mr. Agarwal, I have one final question, and that is not necessarily budget linked, but you could argue it's budget linked. And I'm saying that let's assume the budget dishes out most things that you say, if not all. I would love to know at the start of 2025, how bullish, bearish, neutral is Ramdev Agrawal from a 12-month perspective? I know you're very bullish over the long term. Just trying to think for the slightly shorter term, which is 12 months.
Yeah. Yeah. So 12 months looks to be, I would not be very bullish, let me tell you. I would be a little more on cautionary basis, in the sense that I would expect about first half I would not be that bullish, but second half I'll be very, very bullish. So on the whole, for the year, with little pain in the beginning, I think we should do well. And so I would be cautiously optimistic for 25-26, particularly back-ended.
I want to get your view, Mr. Agarwal, on what we've been seeing in terms of tariffs. And while, if I would look at it from three factors: one, what the government does; one, what corporate India does in terms of its earnings and its performance; and then one is geopolitical. And geopolitical factors are going to be dominated by tariffs. All the announcements this morning, how did you look at it? And is this an opportunity for India or a threat?
I think it will be both ways, in the sense that I think it will be more of an opportunity, because the big daddy in the global manufacturing is China. And if China is being restricted, clearly the tenor of Trump's tariff policy looks to be make Chinese imports a little uneconomical, so that the local manufacturing becomes a little more viable. To that extent, if there's not so much of tariff on Indian imports, probably it will be a huge tailwind, longer term tailwind for Indian manufacturers to step up their effort and export a lot more to the US. But that looks to be pretty, what do you call, simple analysis of what is going to come. It's a very complex thing. We have to play as it comes. So let's not speculate anything till final things have come.
Okay, fair enough. We don't know yet. I mean, if tariffs for China, good for India, we don't know what's going to happen from the Indian perspective. But in the context of this budget, Mr. Agrawal, what do you think we need to see? Would you wait to hear some clear policy direction there?
Yeah, so clearly, as I said, their ultimate North Star is the Viksit Bharat by 2047. And it is very well clearly laid out that compounded growth of about 8% is required. We are at about less than 6% right now, as it turns. So you have to have very clear policy guidelines. And I mean, where there is will, there is a way. And once Mr. Modi has set his eyes on Viksit Bharat and 8% growth, all the forces and the policy making will come together, whether it is a deregulation of the businessman or ease of doing business, regulators coming, little soft pedaling on the operators. You know, so I mean, say like credit flow into the economy. Once you slow down the credit flow into the economy, a lot of other measures don't work. So I think first they have to do the plumbing of increasing the credit flow into the economy, and that I think at least economic surveys talked about it. Let's see whether it comes or not. Or maybe it may not be in the budget, but at least follow on to the budget. There could be rate cut. There could be. I would expect a lot more monetary action than the fiscal action as we go forward in next 1 month.
Just, I know we've been saying one last for a while, but this is really the last one. I'm just wondering, how are you looking at the pain point in the markets right now? And do you see Feb 1st and then Feb 7th after the monetary policy opportunity for a pivot here? Just wanting to get what's in your head right now when you think about where Indian equity is going.
Yeah. See, broader market last year, actual portfolios did very well, like anywhere between 35 to 40, 50% return on the back of the broad index doing just about 8-10%. So clearly we have beaten the index last year. This year, I think index will come and beat us all. So most likely, it will be very tough for most of the active managers to beat the broad index. And hence, there could be a churn from mid and small to large cap. But that happens only when foreigners, they start buying big time, because they love to buy large cap, and large cap valuations have become very reasonable. So let's see when the tide turns, and it turns when you don't expect it. So quite possible times are coming when things may change and surprise us the pace at which it changes. So I would think that there are a lot happening in the Indian economy. Large caps are reasonably priced. Mid and small are still slightly elevated, and that IPO market is kind of bringing it down one by one, because the offerings are there relentlessly. So it's one of the hottest IPO market. I think one of the things which I didn't say, and I think it didn't come even in the economic survey, is the flow of the risk capital, unprecedented flow of risk capital in the economy. If it is harnessed well, it can change the complete trajectory of economic growth and the pace at which we can develop. So that is what is going to happen in next 1 or 2 years, and I would like to see how the FM helps that flow and uses that risk capital flow into the economy very, very creatively.
Well, let's hope a lot of these wishes turn out to be true. Mr. Agrawal, thank you so much for joining in today and giving us your thoughts. Really appreciate your time.
Thanks.
All right, that's an important market view from Ramdev Agrawal of Motilal Oswal. And just before we ask the follow-ups to some of these points, and in fact, I think the points collaborated between what Mr. Sehta said, what Mihir Vora said, and what Mr. Agrawal had to say. But before we do that, just a quick perspective from our research team as well, which has been waiting to talk about what should you watch out for ahead of the budget. Remember, it's not a bad market in that We are at about 1/3% in the green ahead of the budget, and small caps continue to trudge higher. In fact, it's not a trudge really. With the 1.7% gain yesterday and the 1% uptick today, small caps are really doing well. What are the stocks to watch ahead of the budget? Somit is here with a list of some of those. Somit, tell us the names and why you have chosen those.
Well, firstly, top on the list is ITC, because in the last 3 budgets we have not seen any major tax hike related to cigarette come in, and so Street is expecting that there would be definitely a tax hike on cigarettes this time. So if it's a double-digit tax hike, then definitely it's negative for ITC, but a mid to high single-digit tax hike would be neutral, and a low single-digit tax hike would definitely be positive for ITC. Apart from that is the capital goods and road infra companies like L&T, IRB Infra, Dilip Bilcon, that would be in focus. Now the Street is saying that if the capital expenditure growth is less than 15%, then it could be negative for the capital goods and the road infra companies. Then there are rural focused companies like Imami, Dabur, Jyoti Labs, Chambal Fertilizers, GSFC, M&M Finance and L&T Finance. So any increased allocation towards rural spending, agriculture spending, rural schemes would definitely be positive for these rural focused companies. Then there are housing finance companies like PNB Housing, LIC Housing, Awas Housing. All these stocks would remain in focus because any increased allocation towards CLSS scheme, that is the housing scheme, or PMAY scheme would definitely be positive for this housing finance companies. Then there are oil marketing companies like IOCL, BPCL and HPCL, and these stocks would definitely remain in focus given the fact that they have incurred huge LPG subsidy losses in FY25. So any lower allocation towards subsidy, LPG subsidy would definitely be negative for the oil marketing companies. And lastly, it's Adani Green, Tata Power and Wari Renewables. All these stocks would remain in focus because government has clearly showed their focus or intent towards increasing solar energy. So any increased allocation towards rooftop solar would definitely be positive for Adani Power, Wari Renewables and Tata Power.
For that, Samit, so those are some of the stocks that you should look at, and some of them have already run up actually in anticipation. There's just about 13 minutes left for the speech to start. We're taking a very short break and coming right back. How do you set up for trade in this last bit before the speech? Stay tuned for that and more. This is the day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you. STT definitely needs to change.
Old tax regime.
The 1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets. General elections.
Union budget.
2 more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh. That was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40%.
Welcome back. Thanks so much for tuning in, staying tuned to NDTV Profit. Now, this is something that has come up in conversation in the last 1 hour, 15 minutes. And that is it okay to miss the fisc glide path targets if the intent is to spur growth? And Mihir Vora, you look at these numbers very, very closely, right? The fisc deficit, the income that the government has, the fixed expenditures, etc. One, does the government have enough headroom for FY26, not just FY25 by the way, to keep that momentum on capex example and at the same time boost consumption? And if it does not, is it okay to miss the fisc deficit glide path target for FY26 if they are doing it in the right spaces, which makes the market believe that they are wanting to spur growth? And what would you have, even if they have the budget, or even if they have the numbers, is it prudent to do that, or would you not want it?
See, I don't think the RBI and the government are in a mindset to deviate too much from the glide path that has been shown to the market, because I think we as a country are very conscious about the fact that we tried so hard to get into the global bond indices. And that does come with some kind of soft commitments and understandings about where the fiscal direction should go. So the mindset is not really to deviate. That's one. Having said that, if you look at the tax collections and if you introduce a little more discipline in the taxation regime, there is a scope for tax to GDP to go up. In spite of having introduced GST, etc., the tax to GDP ratio is creeping up very slowly. So there is a scope for better compliance, better this thing, not terrorism but compliance, right? There is scope there. So I'd rather that they focus on increasing the tax to GDP rather than increasing taxes. And if we can get a nominal GDP growth of closer to 12% rather than 10.5%, then there will be scope for extra spending, I would say.
Okay, Mr. Sethap, just the same question to you really.
Yeah. So I don't think they will want to miss the fiscal deficit number for next year as well.
Yeah.
Maybe year thereafter, because of the 8-pay commission, this, that, there might be some aberration. But at least for next year, I think they'll still stay with the fiscal deficit number. At the same time, I do feel that they will want to bring growth much higher than what we are currently seeing. And while it's a wish, I'm not sure whether it will happen. If it means that government capex, in order to be maintained, needs some revenue, I think the best course and the correct course for them to take would be more aggressive on the disinvestments. I think, while I'm not sure they will do it.
Believe it, sir.
Sorry?
While the market even believe that if they're aggressive, because they are not meeting the targets even for this year, right? Or the last year, or the year before that, what have you?
Yes. So the point that I'm trying to make is what they ought to do.
Okay.
And probably if they do this, they should not give up on infrastructure building, government capex, because that's what will crowd in even private investment.
Sure.
But giving up on growth would be a bad idea, because taxes will really come from growth as well. The buoyancy in taxes will come to a large extent also from growth. So I don't think they should sacrifice growth. They will not want to sacrifice fiscal deficit. So I am trying to say that if you sacrifice growth, in any case taxes will come down and fiscal deficit will be a problem. So you must maintain growth, and if that requires disinvestment, but capex, government capex has to be there. So that's the way I would feel they should balance their books. But government capex should not be sacrificed. Fiscal deficit they won't, and I think they should not. We've tasted the fruits of a good macro stable environment, and I don't think they'll want to give that up very easily.
Just some of the focus areas that we need to look at, and Mihir, let's get, we have 5 minutes to go for the speech, so let's get a little specific on the markets just for a bit. And we were speaking in the break about how a lot of people just don't want to trade on the budget day, but there are a lot of people who do, and many of them watching us right now. Thank you for all your views, even on our YouTube stream. Just trying to understand whether the typical rail, solar energy, defense push is something that is a safe play this morning.
100%, because these are structural plays and the direction is very clear, whether it's indigenization of defense manufacturing, whether it's the shift from coal and non-renewables to renewables. So those are structural changes and those are not going to go away. So irrespective of the budget, these are certain themes which are going to be there for the longer term, I would say.
Okay, and if the budget gives focus, that's an added impetus.
That's an added impetus. Absolutely.
Okay. So, well, watch out for that bucket, if you will, of pockets wherein there has been the continued focus and that continues too as well. Mr. Sethar, you're not a markets person, but very, very quickly, if there is some tax changes, etc., in order to spur consumption, you think that would be a welcome move? And does that spur the sentiment around consumption?
Absolutely, I think so.
Okay.
Okay, so interesting piece on, and this budget important because the last budget was in July, and you walked in and said budget phir se aa gaya itna jaldi. That sets up perfectly for this piece that our colleague Hiral has done, where she's tracked markets since the last budget in July and today. Important because what a change in mood since these two events. Take a look.
If we can just move to the key 9 aspects which the markets had considered, which the budget 2024 had considered, that will be key. Firstly, disappointed investors, as Neeraj also mentioned, however, rewarded some taxpayers, right? So that was one of the key focus areas. But there were 9 things that Nirmala Sitharaman actually looked at. One was productivity and resilience with regards to agriculture. So schemes with agriculture that were announced. Employment and skilling was their next focus area. Moving on, the others were in terms of inclusive HR development and social justice, manufacturing and services where PLI schemes were announced to some extent. Urban development was the other aspect, and energy security with renewables was one of the focus areas. Infrastructure, which is the crux, capex has been slowing down. What do they do from here on? Innovation R&D was again what they focused on as well. And very lastly, if you see in terms of next generation reforms. Now, whether all of this has actually helped markets or not, absolutely not. Nifty, a downtick of 5% since the previous budget, where you had broader markets which actually went ahead and underperformed as well to the tune of almost around 7 to 9.5%. So that's the mid cap and the small cap underperformance. Now, very interesting. The performance tells you that the markets were not happy because all your domestic oriented sectors were the ones which have underperformed. From energy to oil and gas, real estate, PSU banks and FMCG, down to the tune of almost around 11 to 21% from the previous budget to now. What has outperformed? It's your export-oriented sectors, Nifty IT, Nifty Pharma, up to the tune of almost around 3 to 6%. So you clearly know that it's the domestic policies which have not really been working for India Inc. It's the export-oriented ones. And similar is the trend if you see in terms of gainers and losers. From a DV slab to Wipro, Bajaj Finance, Holdings and a Bharti Airtel, gains to the tune of almost 12 to 26% that did come in. What was losing? Adani Green did lose out. Yes, there was a Hindenburg impact coming in there. But you had a BHEL, IndusInd Bank, Tata Motors, JSW Energy, all in the range of around 30 to 36%, which were under pressure. Let's look at the broader markets. If you see Nifty 500, you have 366 stocks that have actually given negative returns since the previous budget out of Nifty 500. So that tells you the quantum of underperformance that has come in there. And if you talk about the mid-cap companies, BSE actually is outperformed with gains of nearly 2.3 times. But Lloyds Metal, Paytm, Coforge, Dixon, these are the ones which were losing to the tune of around 30 to 75%, gaining, I beg your pardon, to the tune of 30 to 75%. Whereas names like Cochin Shipyard, Vodafone Idea, MRPL, SJVN, Exide Industries, all down in the range of around 35 to 45%. Small caps, you have Amber Enterprises, Piramal, KFin Tech, Aster DM, MCX, all up in the range of 40 to 50%. Whereas if you see in terms of the losers, if you can have that slide, there you go. Honasa, Sterling, Chennai Petro, Tanla, Jupiter, these were the names which were losing out. So that's in terms of the performance, but let's also look at a few of the other reasons which impacted the markets. You had the largest ever FI sell-off that came in to the tune of almost around 2.7 lakh crore. Secondly, you have analysts who have gone ahead and cut estimates as well with regards to earnings for FY25 and 26. Apart from that, if you talk about the geopolitical concerns, they have been looming on the domestic markets. And very lastly, if you see in terms of the election year, that has seen lower government spends.
Okay, first visuals coming in from Parliament. And the customary noise around it as well. Remember, it's also the start of the budget session. Honourable Speaker in the chair, let's listen in.
सदस्यगण, बजट के बाद राज्यपाल अभिभाषण में आपको पर्याप्त अवसर दूंगा। मेरा आपसे निवेदन है, नहीं माननीय अखिलेश जी, आपने संसद की मर्यादा को आप बना के रखें। कभी बजट भाषण के अंदर इस तरीके का नहीं हुआ, ये उचित नहीं है, ये उचित नहीं है। अखिलेश जी प्लीज, मैं आपको मौका दूंगा राज्यपाल अभिभाषण पे, प्लीज। नो, ये तरीका ठीक नहीं है। नो, राज्यपाल अभिभाषण पे चर्चा होगी। नो तरीका।
Honorable Speaker, I present the budget for 25-26. This budget continues our government's efforts to A. Accelerate growth, B. Secure inclusive development, C. Invigorate private sector investments, D. Uplift household sentiments, and E. Enhance spending power of India's rising middle class. Together, we embark on a journey to unlock our nation's tremendous potential for greater prosperity and global positioning under the leadership of Honorable Prime Minister Shri Narendra Modi. As we complete the first quarter of the 21st century, continuing geopolitical headwinds suggest lower global economic growth over the medium term. However, our aspiration for a Vikasit Bharat inspires us, and the transformative work we have done during our government's first 2 terms guides us to march forward resolutely. Our economy is the fastest growing among all major economies. Our development track record for the past 10 years and structural reforms have drawn global attention. Confidence in India's capability and potential has only grown in this period. We see the next 5 years as a unique opportunity to realize Sabka Vikas, stimulating balanced growth of all regions. The great Telugu poet and playwright Gurujada Apparao had said, "Deshamante matti kadoy, deshamante manushuloy," meaning a country is not just its soil, a country is its people. In line with this, for us, Vikasit Bharat encompasses zero poverty, 100% quality good school education, access to high quality, affordable and comprehensive health care, 100% skilled labor with meaningful employment, 70% women in economic activities, and farmers making our country the food basket of the world. In this budget, the proposed development measures span 10 broad areas, focusing on Garib, youth, Annadata, and Nari, spurring agricultural growth and productivity, building rural prosperity and resilience, taking everyone together on an inclusive growth path, boosting manufacturing and furthering Make in India, supporting MSMEs, enabling employment-led development, investing in people, economy, and innovation, securing energy supplies, promoting exports, and nurturing innovation. For this journey of development, our four powerful engines are agriculture, MSME, investments, and exports. The fuel, our reforms, our guiding spirit, inclusivity, and the destination, Vikasit Bharat. This budget aims to initiate transformative reforms across 6 domains. During the first 5 years, these will augment our growth potential and global competitiveness. The domains are taxation, power sector, urban development, mining, financial sector, and regulatory reforms. Agriculture as the first engine. Now I move to specific proposals, beginning with agriculture as the first engine. Prime Minister Dhan Dhanya Krishi Yojana, developing agri-districts program. Motivated by the success of the aspirational district program, our government will undertake a Prime Minister Dhan Dhanya Krishi Yojana in partnership with states. Through the convergence of existing schemes and specialized measures, the program will cover 100 districts with low productivity, moderate crop intensity, and below average credit parameters. It aims to 1. Enhance agricultural productivity, 2. Adopt crop diversification and sustainable agricultural practices, 3. Augment post-harvest storage at the panchayat and block level, 4. Improve irrigation facilities, and 5. Facilitate availability of long-term and short-term credit. This program is likely to help 1.7 crore farmers. Building rural prosperity and resilience. A comprehensive multi-sectoral rural prosperity and resilience program will be launched in partnership with the states. This will address underemployment in agriculture through skilling, investment, technology, and invigorating the rural economy. The goal is to generate ample opportunities in rural areas so that migration is an option but not a necessity. The program will focus on rural women, young farmers, rural youth, marginal and small farmers, and landless families. The details are in Annexure A. Domestic best practices will be incorporated, and appropriate technical and financial assistance will be sought from multilateral development banks. In phase 1, 100 developing agri-districts will be covered. Atmanirbharta in pulses. Our government is implementing the National Mission for Edible Oil Seed for achieving Atmanirbharta in edible oils. Our farmers have the capability to grow enough for our needs and more. 10 years ago, we made concerted efforts and succeeded in achieving near self-sufficiency in pulses. Farmers responded to the need by increasing the cultivated area by 50%, and government arranged for procurement and remunerative prices. Since then, with rising incomes and better affordability, our consumption of pulses has increased significantly. Our government will now launch a 6-year mission for Atmanirbharta in pulses with a special focus on Tuar, Urad, and Masoor. Details are in Annexure B. Central agencies such as NAFED and NCCF will be ready to procure these 3 pulses as much as offered during the next 4 years from farmers who register with these agencies and enter into agreements. Comprehensive program for vegetables and fruits. It is encouraging that our people are increasingly becoming aware of their nutritional needs. It is a sign of a society becoming healthier. With rising income levels, the consumption of vegetables, fruits, and Shri Anna is increasing significantly. A comprehensive program to promote production, efficient supplies, processing, and remunerative prices for farmers will be launched in partnership with the states. Appropriate institutional mechanisms for implementation and participation of farmer producer organizations and cooperatives will be set up. Makhana board in Bihar. For this, there is a special opportunity for the people of Bihar. A Makhana board will be established in the state to improve production, processing, value addition, and marketing of Makhana. The people engaged in these activities will be organized into FPOs. The board will provide hand-holding and training support to Makhana farmers and will also work to ensure they receive the benefits of all relevant government schemes. A national mission on high-yielding seeds will be launched, aimed at 1. Strengthening research ecosystem, 2. Targeted development and propagation of seeds with high yield, pest resistance, and climate resilience, and 3. Commercial availability of more than 100 seed varieties released since July 2024. India ranks second largest globally in fish production and aquaculture. Seafood exports are valued at 60,000 crore rupees. To unlock the untapped potential of the marine sector, our government will bring in an enabling framework for sustainable harnessing of fisheries from Indian exclusive economic zone and high seas, with a special focus on the Andaman and Nicobar and Lakshadweep Islands. For the benefit of lakhs of cotton growing farmers, I am pleased to announce a mission for cotton productivity. This 5-year mission will facilitate significant improvements in productivity and sustainability of cotton farming and promote extra long staple cotton varieties. The best of science and technology support will be provided to farmers. Aligned with our integrated 5F vision for the textile sector, this will help in increasing incomes of the farmers and ensure a steady supply of quality cotton for rejuvenating India's traditional textile sector. Kisan credit cards facilitate short-term loans for 7.7 crore farmers, fishermen, and dairy farmers. The loan limit under modified interest subvention scheme will be enhanced from 3 lakh rupees to 5 lakh rupees for loans taken through the KCC. For Atmanirbharta in urea production, our government had reopened 3 dormant urea plants in the eastern region. To further augment urea supply, a plant with annual capacity of 12.7 lakh metric tons will be set up at Namrup in Assam. India Post, with 1.5 lakh rural post offices, complemented by the India Post Payment Bank and a vast network of 2.4 lakh Dak Sevaks, will be repositioned to act as a catalyst for the rural economy. Details are at Annexure C. India Post will also be transformed as a large public logistics organization. This will meet the rising needs of Vishwakarmas, new entrepreneurs, women, self-help groups, MSMEs, and the large business organizations. Our government will provide support to NCDC for its lending operations for the cooperative sector. MSMEs as the second engine. Now I move to MSMEs as the second engine, which encompasses manufacturing and services with a focus on MSMEs numbering 5.7 crores. Currently, over 1 crore registered MSMEs, employing 7.5 crore people and generating 36% of our manufacturing, have come together to position India as a global manufacturing hub. With their quality products, these MSMEs are responsible for 45% of our exports. To help them achieve higher efficiencies of scale, technological upgradation, and better access to capital, the investment and turnover limits for classification of all MSMEs will be enhanced to 2.5 and 2 times respectively. This will give them the confidence to grow and generate employment for our youth. The details are given in Annexure D. To improve access to credit, the credit guarantee cover will be enhanced. First, for micro and small enterprises from 5 crore to 10 crore rupees, leading to additional credit of 1.5 lakh crores in the next 5 years. Second, for startups from 10 crore rupees to 20 crore rupees, with the guarantee fee being moderated to 1% for loans in 27 focus sectors which are important for Atmanirbhar Bharat. And for well-run exporter MSMEs, for term loans up to 20 crore rupees. Also for the micro enterprises, we will introduce customized credit cards with a 5 lakh rupee limit for micro enterprises registered on Udyam portal. In the first year, 10 lakh such cards will be issued. Fund of funds for startups. The alternate investment fund, AIFs, for startups have received commitments of more than 91,000 crores rupees. These are supported by the fund of funds set up with the Government of India's contribution of 10,000 crore rupees. Now, a new fund of funds with expanded scope and a fresh contribution of another 10,000 crore rupees will be set up. A new scheme will be launched for 5 lakh women, scheduled castes and scheduled tribes, first-time entrepreneurs. This will provide term loans up to 2 crore rupees during the next 5 years. The scheme will incorporate lessons from the successful Stand Up India scheme. Online capacity building for entrepreneurship and managerial skills will also be organized. Measures for labor-intensive sectors. To promote employment and entrepreneurship opportunities in labor-intensive sectors, our government will undertake specific policy and facilitation measures. To enhance the productivity, quality, and competitiveness of India's footwear and leather sector, a focused product scheme will be implemented. The scheme will support design capacity, component manufacturing, and machinery required for production of non-leather quality footwear, besides the support for leather footwear and products. The scheme is expected to facilitate employment for 22 lakh persons, generate over 4 lakh crore rupees, and exports of over 1.1 lakh crore rupees. Measures for the toys sector. Building on the National Action Plan for Toys, we will implement a scheme to make India a global hub for toys. The scheme will focus on development of clusters, skills, and a manufacturing ecosystem that will create high-quality, unique, innovative, and sustainable toys that will represent the Made in India brand. Support for food processing. In line with our commitment towards Purvodaya, we will establish a National Institute of Food Technology, Entrepreneurship, and Management in Bihar. The institute will provide a strong fillip to food processing activities in the entire eastern region. This will result in 1. Enhanced income for the farmers through value addition to their produce, and 2. Skilling entrepreneurship and employment opportunities for the youth. Manufacturing mission, furthering Make in India. Our government will set up a national manufacturing mission covering small, medium and large industries for furthering Make in India by providing policy support, execution roadmaps, governance and monitoring framework for central ministries and states. Details are in Annexure E. Given our commitment to climate-friendly development, the mission will also support clean tech manufacturing. This will aim to improve domestic value addition and build our ecosystem for solar PV cells, EV batteries, motors and controllers, electrolyzers, wind turbines, very high voltage transmission equipment and grid scale batteries. Investment as the third engine. Now I move to investment as the third engine, which encompasses investing in people, investing in the economy, and investing in innovation. Investing in people. Saksham Anganwadi and Poshan 2.0. Saksham Anganwadi and Poshan 2.0 program provides nutritional support to more than 8 crore children, 1 crore pregnant women and lactating mothers all over the country, and about 20 lakh adolescent girls in aspirational districts and the Northeast region. The cost norms for these nutritional support will be enhanced appropriately. Atal Tinkering Labs. 50,000 Atal Tinkering Labs will be set up in government schools in the next 5 years to cultivate the spirit of curiosity and innovation and foster a scientific temper among young minds. Broadband connectivity to government secondary schools and PHCs. Broadband connectivity will be provided to all government secondary schools and primary health centers in rural areas under the BharatNet project. Bharatiya Bhasha Pustak Scheme. We propose to implement a Bharatiya Bhasha Pustak scheme to provide digital form Indian language books for schools and for higher education. This aims to help students understand their subjects better and in their language. National Centers of Excellence for Skilling. Building on the initiative announced in the July 24 budget, 5 national centers of excellence for skilling will be set up with global expertise and partnerships to equip our youth with the skills required for Make for India, Make for the World manufacturing. The partnership will cover curriculum design, training of trainers, and a skills certification framework and periodic reviews. Expansion of capacity in IITs. Total number of students in 23 IITs has increased 100% from 65,000 to 1.35 lakh in the past 10 years. Additional infrastructure will be created in the 5 IITs started after 2014 to facilitate education for 6,500 more students. Hostel and other infrastructure capacity at IIT Patna will also be expanded. Center of Excellence. Center of Excellence in AI for Education. I had announced 3 centers of excellence in artificial intelligence for agriculture, health, and sustainable cities in 2023. Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores. Expansion of medical education. Our government has added almost 1.1 lakh undergraduate and postgraduate medical education seats in 10 years, an increase of 130%. In the next year, 10,000 additional seats will be added in medical colleges and hospitals towards the goal of adding 75,000 seats in the next 5 years. Daycare cancer centers in all district hospitals. Our government will facilitate setting up of daycare cancer centers in all district hospitals in the next 3 years. 200 centers will be established in 25-26 itself. Strengthening urban livelihoods. Our government has been giving priority to assisting urban poor and vulnerable groups. A scheme for socio-economic upliftment of urban workers will be implemented to help them improve their incomes, have sustainable livelihoods, and a better quality of life. PM Swanidhi scheme has benefited more than 68 lakh street vendors, giving them respite from high-interest informal sector loans. Building on this success, the scheme will be revamped with enhanced loans from banks, UPI-linked credit cards with 30,000 rupees limit, and capacity building support. Social Security Scheme for welfare of online platform workers. Gig workers of online platforms provide great dynamism to the new age services economy. Recognizing their contribution, our government will arrange for their identity cards and registration on the e-Shram portal. They will be provided healthcare under PM Jan Arogya Yojana. This measure is likely to assist nearly 1 crore gig workers. Investing in the economy. Public-private partnership in infrastructure. Each infrastructure-related ministry will come up with a 3-year pipeline of projects that can be implemented in PPP mode. States will also be encouraged to do so and can seek support from the India Infrastructure Project Development Fund, which is a scheme to prepare PPP proposals. Support to states for infrastructure. An outlay of 1.5 lakh crore is proposed for the 50-year interest-free loans to states for capital expenditure and incentives for reforms. Building on the success of the first asset monetization plan announced in 2021, the second plan for 2025 to 30 will be launched to plow back capital of 10 lakh crore in new projects. Regulatory and fiscal measures will be fine-tuned to support the plan. Jal Jeevan Mission. Since 2019, 15 crore households representing 80% of India's rural population have been provided access to portable tap water connections. To achieve 100% coverage, I am pleased to announce the extension of this mission until 2028 with an enhanced total outlay. The mission's focus will be on the quality of infrastructure and O&M of rural piped water supply schemes through Jan Bhagidari. A separate MOU or separate MOUs will be signed with the states and union territories to ensure sustainability and citizen-centric water services delivery. Urban sector reforms. Building on the July budget proposals, urban sector reforms related to governance, municipal services, urban land and planning will be incentivized. Urban Challenge Fund. The government will set up an Urban Challenge Fund of 1 lakh crore rupees to implement the proposals for cities as growth hubs, creative redevelopment of cities, and for water and sanitation purposes announced in the July budget. This fund will finance up to 25% of the cost of bankable projects, with a stipulation that at least 50% of the cost is funded from bonds, bank loans, and PPPs. An allocation of 10,000 crore is proposed in 2025-26. Power sector reforms. We will incentivize electricity distribution reforms and augmentation of intra-state transmission capacity by states. This will improve financial health and capacity of electricity companies. Additional borrowing of 0.5% of GSDP will be allowed to states contingent on these reforms. Nuclear energy mission for Vikasit Bharat. Development of at least 100 gigawatt of nuclear energy by 2047 is essential for our energy transition efforts. For an active partnership with the private sector towards this goal, amendments to the Atomic Energy Act and the Civil Liability for Nuclear Damage Act will be taken up. A nuclear energy mission for research and development of small modular reactors with an outlay of 20,000 crore will be set up. At least 5 indigenously developed small modular reactors will be operationalized by 2033. Shipbuilding. The shipbuilding financial assistance policy will be revamped to address cost disadvantages. This will also include credit notes for shipbreaking in Indian yards to promote the circular economy. Large ships above a specified size will be included in the infrastructure harmonized master list. Shipbuilding clusters will be facilitated to increase the range, categories, and capacity of ships. This will include additional infrastructure, facilities, skilling, and technology to develop the entire ecosystem. Maritime Development Fund. For long-term financing for the maritime industry, a Maritime Development Fund with a corpus of 25,000 crore rupees will be set up. This will be for distributed support and promoting competition. This will have up to 49% contribution by the government, and the balance will be mobilized from ports and from private sector. UDAN regional connectivity schemes. UDAN has enabled 1.5 crore middle-class people to meet their aspirations for speedier travel. The scheme has connected 88 ports, airports, and operationalized 619 routes. Inspired by that success, a modified UDAN scheme will be launched to enhance regional connectivity to 120 new destinations and carry 4 crore passengers in the next 10 years. 4 crore additional passengers in the next 10 years. The scheme will also support helipads and smaller airports in hilly, aspirational, and northeast regional districts. Greenfield airports will be facilitated in Bihar to meet the future needs of the state. These will be in addition to the expansion of the capacity of Patna Airport and a brownfield airport in Beta. Western Kosi Canal project in Mithilanchal. Financial support will be provided for the Western Kosi Canal ERM project, benefiting a large number of farmers, cultivating over 50,000 hectares of land in the Mithilanchal region of Bihar. Mining sector reforms. Mining sector reforms, including those for minor minerals, will be encouraged through sharing of best practices and institutions of a state mining index. A policy for recovery of critical minerals from tailings will be brought out. Under the special window for affordable and mid-income housing, SWAMI, 50,000 dwelling units in stressed housing projects have been completed and keys handed over to home buyers. Another 40,000 units will be completed in 2025, further helping middle-class families who are paying EMIs on loans taken for apartments while also paying rent for their current dwellings. Building on this success, SWAMI Fund 2 will be established as a blended finance facility with contribution from the government, banks, and private investors. This fund of 15,000 crore rupees will aim for expeditious completion of another 1 lakh units. PM Gati Shakti data for private sector. For furthering PPPs and assisting the private sector in project planning, access to relevant data and maps from the PM Gati Shakti portal will be provided. Tourism for employment-led growth. Top 50 tourist destination sites in the country will be developed in partnership with states through a challenge mode. Land for building key infrastructure will have to be provided by the states. Hotels in these destinations will be included in the infrastructure harmonized list. The following measures will be taken for facilitating employment-led growth. Organizing intensive skill development programs for our youth, including in institutes of hospitality management. Providing mudra loans for homestays. Improving ease of travel and connectivity to tourist destinations. Providing performance-linked incentives to states for effective destination management, including tourist amenities, cleanliness, and marketing efforts. And introducing streamlined e-visa facilities along with visa fee waivers for certain tourist groups. Continuing with the emphasis on places of spiritual and religious significance in the July budget, there will be a special focus on destinations related to the life and times of Lord Buddha. Medical tourism and heal in India. Medical tourism and heal in India will be promoted in partnership with the private sector along with capacity building and easier visa norms. Investing in innovation. To implement private sector-driven research, development, and innovation initiatives announced in the July budget, I am now allocating 20,000 crore rupees for this purpose. A deep tech fund of funds will also be explored to catalyze the next generation startups as a part of this initiative. In the next 5 years, under the PM Research Fellowship Scheme, we will provide 10,000 fellowships for technological research in IITs and IISc with enhanced financial support. The second gene bank with 10 lakh germplasm lines will be set up for future food and nutritional security. This will provide conservation support to both public and private sectors for genetic resources. We will start a national geospatial mission to develop foundational geospatial infrastructure and data. Using PM Gati Shakti, this mission will facilitate modernization of land records, urban planning, and design of infrastructure projects. A Gyan Bharatam mission for survey, documentation, and conservation of our manuscript heritage with academic institutions, museums, libraries, and private collectors will be undertaken to cover more than 1 crore manuscripts. We will set up a national digital repository of Indian knowledge systems for knowledge sharing. Now I move to exports as the fourth engine. We will set up an export promotion mission with sectoral and ministerial targets driven jointly by the Ministries of Commerce, MSME, and Finance. It will facilitate easy access to export credit, cross-border factoring support, support to MSMEs to tackle non-tariff measures in overseas markets. A digital public infrastructure, Bharat Trade Net, for international trade will be set up as a unified platform for trade documentation and financing solutions. This will complement the Unified Logistics Interface platform. The BTN will be aligned with international practices. Support will be provided to develop domestic manufacturing capacities for our economy's integration with global supply chains. Sectors will be identified based on objective criteria. Facilitation groups with participation of senior officers and industry representatives will be formed for select products and supply chains. Through this, there are huge opportunities related to Industry 4.0, which needs high skills and talent. Our youth have both. Our government will support the domestic electronic equipment industry to leverage this opportunity for the benefit of our youth. A national framework will be formulated as guidance to states for promoting global capability centers in emerging Tier 2 cities. This will suggest measures for enhancing availability of talent and infrastructure, building bylaw reforms, and mechanisms for collaboration with industry. Our government will facilitate upgradation of infrastructure and warehousing for air cargo, including high-value perishable horticultural produce. Cargo screening and customs protocol will be streamlined and made user-friendly. Reforms as the fuel. Over the past 10 years, our government has implemented several reforms for convenience of taxpayers, such as faceless assessment, 2, taxpayer charter, 3, faster returns, 4, almost 99% returns being on self-assessment, and 5, Vivad Se Vishwas scheme. Continuing these efforts, I reaffirm the commitment of the tax department to trust first, scrutinize later. I also propose to introduce the new income tax bill next week. I will detail the indirect tax reforms and changes in direct taxes in Part B. Financial sector reforms. The FDI limit for the insurance sector will be raised from 74 to 100%. This enhanced limit will be available for those companies which invest the entire premium in India. The current guardrails and conditionalities associated with foreign investment will be reviewed and simplified. The services of India Post Payment Bank will be deepened and expanded in rural areas. NABFID will set up a partial credit enhancement facility for corporate bonds for infrastructure. Public sector banks will develop Grameen Credit Score framework to serve the credit needs of SHG members and people in rural areas. A forum for regulatory coordination and development of pension products will be set up. To implement the earlier announcement on simplifying the KYC processes, the revamped Central KYC Registry will be rolled out in 2025. We will also implement a streamlined system for periodic updating. Requirements and procedures for speedy approval of company mergers will be rationalized. The scope for fast-track mergers will also be widened and the process made simpler. As proposed in the interim budget, we signed bilateral investment treaties with 2 countries in 2024 to encourage sustained foreign investment, and in the spirit of First Develop India, the current model BIT will be revamped and made more investor-friendly. In the last 10 years, in several aspects, including financial and non-financial, our government has demonstrated a steadfast commitment to ease of doing business. We are determined to ensure that our regulations must keep up with technological innovations and global policy developments. A light-touch regulatory framework based on principles and trust will unleash productivity and employment. Through this framework, we will update regulations that were made under old laws. To develop this modern, flexible, people-friendly, and trust-based regulatory framework appropriate for the 21st century, I propose 4 specific measures. A high-level committee for regulatory reforms will be set up for a review of all non-financial sector regulations, certifications, licenses, and permissions. The committee will be expected to make recommendations within a year. The objective is to strengthen trust-based economic governance and take transformational measures to enhance ease of doing business, especially in matters of inspection and compliances. States will be encouraged to join in this endeavor. An investment friendliness index of states will be launched in 2025 to further the spirit of competitive, cooperative federalism. Under the Financial Stability and Development Council, a mechanism will be set up to evaluate impact of the current financial regulations and subsidiary instructions. It will also formulate a framework to enhance their responsiveness and development of the financial sector. In the Jan Vishwas Act 2023, more than 180 legal provisions were decriminalized. Our government will now bring up the Jan Vishwas Bill 2.0 to decriminalize more than 100 provisions in various laws. I now move to fiscal policy. In the July budget, I had committed to staying the course for fiscal consolidation. Our endeavor will be to keep the fiscal deficit each year such that central government debt remains on a declining path as a percentage of the GDP. The roadmap for the next 6 years has been detailed in the FRBM statement. Revised estimates for 2024-25. The revised estimate of the total receipts other than borrowings is 31.47 lakh crore rupees, of which the net tax receipts are 25.57 lakh crore rupees. The revised estimate of the total expenditure is 47.16 lakh crore rupees, of which the capital expenditure is about 10.18 lakh crore rupees. The revised estimate of the fiscal deficit is 4.8% of the GDP. Budget estimates for 25-26. Coming to 25-26, the total receipts other than borrowings and total expenditure are estimated at 34.96 lakh crore rupees and 50.65 lakh crore rupees respectively. The net tax receipts are estimated at 28.37 lakh crore rupees. The fiscal deficit is estimated to be 4.4% of GDP. To finance the fiscal deficit, the net market borrowings from dated securities are estimated at 11.54 lakh crore. The balance financing is expected to come from small savings and other sources. The gross market borrowings are estimated at 14.82 lakh crore rupees. I will now move to Part B. Indirect taxes. My proposals relating to customs aim to rationalize tariff structure and address duty inversion. These will also support domestic manufacturing and value addition, promote exports, facilitate trade, and provide relief to common people. Rationalization of customs tariff structure for industrial goods. As a part of comprehensive review of customs rate structure announced in July 2024 budget, I propose to 1. Remove 7 tariff rates. This is over and above the 7 tariff rates removed in 23-24 budget. After this, there will be only 8 remaining tariff rates, including 0 rate. 2. Apply appropriate cess to broadly maintain effective duty incidence, except on a few items where such incidence will reduce marginally. 3. Levy not more than 1 cess or surcharge. Therefore, I propose to exempt social welfare surcharge on 82 tariff lines that are subject to a cess. I shall now take up sector-specific proposals. To provide relief to patients, particularly those suffering from cancer, rare diseases, and other severe chronic diseases, I propose to add 36 life-saving drugs and medicines to the list of medicines fully exempted from basic custom duty. I also propose to add 6 life-saving medicines to the list attracting concessional custom duty of 5%. Full exemption and concessional duty will also respectively apply on the bulk drugs for manufacture of the above. Specified drugs and medicines under patient assistance programs run by the pharmaceutical companies are fully exempt from BCD, provided the medicines are supplied free of cost to the patients. I propose to add 37 more medicines along with 13 new patient assistance programs. Support to domestic manufacturing and value addition. Critical minerals. In the July 2024 budget, I had fully exempted BCD on 25 critical minerals that are not domestically available. I had also reduced BCD of 2 other such minerals to provide a major fillip to their processing, especially by MSMEs. Now, I propose to fully exempt cobalt powder and waste, the scrap of lithium-ion battery, lead, zinc, and 12 more critical minerals. This will help secure their availability for manufacturing in India and promote more jobs for our youth. To promote domestic production of technical textile products such as agro-textiles, medical textiles, and geotextiles at competitive prices, I propose to add 2 more types of shuttle-less looms to the list of fully exempted textile machinery. I also propose to revise the BCD rate on knitted fabrics covered by 9 tariff lines from 10 or 20 to 20% or 115 rupees per kg whichever is higher. Electronic goods. In line with our Make in India policy and to rectify inverted duty structure, I propose to increase the BCD on interactive flat panel display from 10% to 20% and reduce the BCD to 5% on open cell and other components. In 23-24 budget, for the manufacture of open cells of LCD, LED TVs, I had reduced the BCD on parts of open cells from 5% to 2.5%. To further boost the manufacture of such open cells, the BCD on these parts will now stand exempted. Lithium-ion battery. To the list of exempted capital goods, I propose to add 35 additional capital goods for EV battery manufacturing and 28 additional capital goods for mobile phone battery manufacturing. This will boost domestic manufacture of lithium-ion batteries, both for mobile phones and for electric vehicles. Shipping sector. Considering that shipbuilding has a long gestation period, I propose to continue the exemption of BCD on raw materials, components, consumables, or parts for the manufacture of ships for another 10 years. I also propose the same dispensation for shipbreaking to make it more competitive. Telecommunication. To prevent classification disputes, I propose to reduce the BCD from 20% to 10% on carrier-grade Ethernet switches to make it at par with non-carrier-grade Ethernet switches. Export promotion. To facilitate exports of handicrafts, I propose to extend the time period for export from 6 months to 1 year, further extendable by another 3 months if required. I also propose to add 9 items to the list of duty-free inputs. Leather sector. I propose to fully exempt BCD on wet blue leather to facilitate imports for domestic value addition and employment. I also propose to exempt crust leather from 20% export duty to facilitate exports by small tanners. Marine products. To enhance India's competitiveness in the global seafood market, I propose to reduce BCD from 30% to 5% on frozen fish paste, surimi, for manufacture and export of its analog products. I also propose to reduce BCD from 15% to 5% on fish hydrolysates for manufacture of fish and shrimp feed. In July 2024 budget, to promote development of domestic MROs for aircraft and ships, I had extended the time limit for export of foreign origin goods that were imported for repairs from 6 months to 1 year and further extendable by 1 year. I now propose to extend the same dispensation for railway goods. Time limit for provisional assessment. Presently, the Customs Act 1962 does not provide any time limit to finalize provisional assessments, leading to uncertainty and cost to trade. As a measure of promoting ease of doing business, I propose to fix a time limit of 2 years, extendable by a year, for finalizing the provisional assessment. I propose to introduce a new provision that will enable importers or exporters, after clearance of goods, to voluntarily declare material facts and pay duty with interest but without penalty. This will incentivize voluntary compliance. However, this will not apply in cases where department has already initiated audit or investigation proceedings. For industry to better plan their imports, I propose to extend the time limit for the end use of imported inputs in the relevant rules from 6 months to 1 year. This will provide operational flexibility in view of cost and uncertainty of supply. Further, such importers will now have to file only quarterly statements instead of a monthly statement. I now come to my direct tax proposals. In Part A, I have briefly underlined taxation reforms as one of key reforms to realize our vision of Vikasit Bharat. In respect of criminal law, our government had earlier ushered in Bharatiya Nyaya Sanhita, replacing Bharatiya Danda Sanhita. I am happy to inform this august House and the country that for new income tax bill will carry forward the same spirit of Nyaya in its drafting as well. The new bill will be clear and direct in text, with close to half of the present law in terms of both chapters and words. It will be simple to understand for taxpayers and tax administrators, leading to tax certainty and reduced litigation. Reforms, however, are not a destination. They are means to achieve good governance for our people and economy. Providing good governance primarily involves being responsive. The Tirukural captures this in verse 542, which reads, "Vaanokki vaazhum ulagallam, mannavan kol nokki vaazhum kudi," meaning, just as the living beings live expecting rains, citizens live expecting good governance. Our government is committed to keeping an ear to the ground and a finger on the pulse and responding while balancing our national building efforts. The following measures will detail just how our government will, under the guidance of PM Modi, has taken steps to understand and address. I repeat that sentence, sir. The following measures will detail just how our government, under the guidance of PM Modi, has taken steps to understand and address the needs voiced by our citizens. My tax proposals are guided by this spirit. The objectives of my proposals are as follows. Personal income tax reforms with special focus on middle class. Rationalization of TDS and TCS for easing difficulties. Encouraging voluntary compliance. Reducing compliance burden. Ease of doing business, employment and investment. I will come to my proposal on personal income tax towards the end. TDS and TCS, rationalization for easing difficulties. I propose to rationalize tax deduction at source, TDS, by reducing the number of rates and thresholds above which TDS is deducted. Further, threshold amounts for tax deduction will be increased for better clarity and uniformity. The limit for tax deduction on interest for senior citizens is being doubled from the present 50,000 rupees to 1 lakh rupees. Similarly, the annual limit of 2.40 lakh rupees for TDS on rent is being increased to 6 lakh rupees. This will reduce the number of transactions liable to TDS, thus benefiting small taxpayers receiving small payments. The threshold to collect tax at source, the TCS, on remittances under RBI's liberalized remittance scheme, the LRS, is proposed to be increased from 7 lakh to 10 lakhs. I also propose to remove TCS on remittances for education purposes, where such remittances is out of a loan taken from a specified financial institution. Both TDS and TCS are being applied on any transaction related to sale of goods. To prevent such compliance difficulties, I propose to omit the TCS. I also propose that the provisions of the higher TDS deduction will now apply only in non-PAN cases. In July 2024, the delay for payment of TDS up to the due date of filing statement was decriminalized. I propose to provide the same relaxation to TCS provisions as well. The government under the leadership of Prime Minister Modi believes in Sabka Saath, Sabka Vikas, Sabka Vishwas and Sabka Prayas. In line with this, we brought in updated return facility in 2022 for voluntary compliance by taxpayers who had omitted to report their correct income. Our trust in taxpayers was proved right. Nearly 90 lakh taxpayers voluntarily updated their incomes by paying additional tax. Taking this trust further, I now propose to extend the time limit to file updated returns for any assessment year from the current limit of 2 years to 4 years. I propose to reduce the compliance burden for small charitable trusts and institutions by increasing their period of registration from 5 years to 10 years. It is also proposed that disproportionate consequences do not arise for minor defaults such as incomplete applications filed by charitable entities. Presently, taxpayers can claim the annual value of self-occupied properties as nil only on the fulfillment of certain conditions. Considering the difficulties faced by taxpayers, it is proposed to allow the benefit of 2 such self-occupied properties without any condition. To streamline the process of transfer pricing and to provide an alternative to yearly examination, I propose to introduce a scheme for determining arm's length price of international transaction for a block period of 3 years. This will be in line with global best practices. With a view to reduce litigation and provide certainty in international taxation, the scope of safe harbor rules is being expanded. A number of senior and very senior citizens have very old national savings schemes accounts. As interest is no longer payable on such accounts, I propose to exempt withdrawals made from NSS by individuals on or after 29th August 2024. I am also proposing to allow similar treatment to NPS Vatsalya accounts as is available to normal NPS accounts subject to overall limits. In my speech in July 2024, I had promised that all processes, including giving effect to appellate orders, shall be digitalized and made paperless over the next 2 years. So I'm happy to announce that digitalization is being made operational now. In July 2024, we brought in the Vivad Se Vishwas scheme to resolve income tax disputes pending in appeal. The scheme has received a great response, with nearly 33,000 taxpayers having availed of the scheme to settle their disputes. I have a few proposals to promote investment and employment. It is proposed to provide a presumptive taxation regime for non-residents who provide services to a resident company that is establishing or operating an electronics manufacturing facility. I further propose to introduce a safe harbor for tax certainty for non-residents who store components for supply to specified electronics manufacturing units. Presently, the tonnage tax scheme is available only to sea-going ships. The benefits of existing tonnage tax scheme are proposed to be extended to inland vessels registered under the Indian Vessels Act 2021 to promote inland water transport in the country. extension for incorporation of startups. We continue to support the Indian startup ecosystem. I propose to extend the period of incorporation by 5 years to allow the benefit available to startups which are incorporated before 1/4/2030. In order to attract and promote additional activities in the IFSC, I am inter alia proposing specific benefits to ship leasing units, insurance offices, and treasury centers of global companies which are set up in IFSC. Further, to claim benefits, the cutoff date for commencement in IFSC has also been extended by 5 years to 31/3/2030. Category 1 and Category 2 AIFs are undertaking investments in infrastructure and other such sectors. I propose to provide certainty of taxation to these entities on the gains from securities, to promote funding from sovereign wealth funds and pension funds to the infrastructure sector. I propose to extend the date of making an investment by 5 more years up to 31st March 2030. Personal income tax reforms with special focus on middle class. Democracy, demography, and demand are the key support pillars in our journey towards Vikasit Bharat. The middle class provides strength for India's growth. This government, under the leadership of Prime Minister Modi, has always believed in the admirable energy and ability of the middle class in nation building. In recognition of their contribution, we have periodically reduced their tax burden. Right after 2014, the nil tax slab was raised to 2.5 lakhs of rupees, which was further raised to 5 lakh rupees in 2019 and to 7 lakh rupees in 2023. This is reflective of our government's trust on the middle class taxpayers. I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees. So, average income of 1 lakh per month other than the special rate income such as capital gains under the new regime. This limit will be 12.75 lakh for salaried taxpayers due to the standard deduction of 75,000. Slabs and rates are being changed across the board to benefit all taxpayers. The new structure will substantially reduce the taxes of the middle class and leave more money in their hands, boosting household consumption, savings, and investment. In the new tax regime, I propose to revise tax rate structures as follows: 0 to 4 lakh rupees nil, 4.8 lakh rupees to 4 to 8 lakh rupees 5%, 8 to 12 lakh rupees 10%, 12 to 16 lakh rupees 15%, 16 to 20 lakh rupees 20%, 20 to 24 lakh rupees 25%, and above 24 lakh rupees 30%. To taxpayers up to 12 lakh of normal income other than special rate income such as capital gains. I read that again. To taxpayers up to 12 lakh of income other than special rate income such as capital gains, tax rebate is being provided in addition to the benefit due to slab rate reduction in such a manner that there is no tax payable by them. The total tax benefit of slab rate changes and rebate at different income levels can be illustrated with a few examples. A taxpayer in the new regime with an income of 12 lakh rupees will get a benefit of 80,000 rupees in tax, which is 100% of tax payable as per the existing rates. A person having income of 18 lakh rupees will get a benefit of 70,000 rupees in tax, that is 30% of tax payable as per existing rates. A person with an income of 25 lakh gets a benefit of 1,10,000 rupees, that is 25% of his tax payable as per existing rates. Details of my tax proposals are given in the annexure. As a result of these proposals, Honorable Speaker, sir, revenue of about 1 lakh crore in direct taxes and 2,600 crores in indirect taxes will be foregone. Mr. Speaker, sir, with this, I commend the budget to this august House.
Item number
Finance Minister Nirmala Sitharaman leaving the best for the last. You heard the cheers in Parliament. You've probably not heard the cheers in our newsroom and across our PCR. Everyone whooping because this, as promised, is a budget for the middle class, for the salaried income taxpayer. There is now zero tax up to 12 lakh rupees. New slabs have been put into place as well.
1 lakh rupees.
Continue.
Okay, all right. So let's get those details in first. Pranav Saita, I think this is the moment which everyone was waiting for. We expected it. 10 on 10 for guessing it would happen, even though there was a clue from Prime Minister. But what does it mean, these changes in personal income tax?
I somehow think this just brings about an atmosphere of taxpayer excitement, consumption being permitted, and therefore that was the need of the hour, really. This is the time when the finance minister, without giving up too much of taxes, is trying to build the confidence and the taxpayer friendliness kind of environment, plus ensuring that the lost momentum in the economy, which we are seeing for the last few months, particularly on the consumption side, is fully addressed.
How significant are the changes in real terms?
I think these are really significant, unlike many of the previous budgets that we've been seeing for decades where there have been tinkering in the tax rates. This one is really done far more gracefully. I think this will have a very significant impact in terms of both consumption as well as the confidence and the feeling of a taxpayer that what he's contributing has really been recognized.
Okay, this is very important. The other big thing that happened aside of taxation is the fiscal consolidation path, Mihir. 4.8% current year, 4.4% next year. So fiscal prudence is the key. We don't have the number of the capex for the next year, but this year's capex the number is lower as well. So a number on what the fiscal deficit tightening mean per se for markets. But markets came off a little bit. Two, just rolled into that, right? If the base is 10.18 lakh crores for this year, they can mathematically show a 15% growth in capex next year because the receipts number is 10% higher.
Sure. I just got some message saying that the capex number is less than 11 lakhs.
For FY26.
For FY26. So maybe not a 10-15% growth, but probably about 8-9% growth probably, which is a tad below expectations, but nothing to worry about beyond a point. But I think more important is the fact that almost 1 lakh crores of tax incentives in the form of reduced taxes are being given out, which is a decent amount of extra money that the urban consumers can spend.
Well, is Atul Lal disappointed with this? Managing Director, Vice Chairman Dixon with us. Mr. Lal, thanks for joining in. One, of course, more money in the hands of the taxpayer, which is always good. But the capex number, by the math that we seem to be doing, is less than a 6-7% growth on a reduced number of 10.18 lakh crores for FY25. Technically, FY26 number might actually match FY25 or be slightly below as per the earlier estimates. Your initial thoughts?
So undoubtedly, I think reduction and exemption of income tax for the salaried people up to 12 lakhs is a very, very major positive. is going to trigger a positive sentiment, is going to trigger demand. And that's what the call of the day was. One wants to congratulate Honorable Finance Minister for this very significant step forward. As far as capex is concerned, yes, there has been a minor reduction, it seems. But please appreciate that Finance Minister is on a fiscal consolidation path, and she's been meeting the targets. That means we are building for the future. We're not taking debt on the government side, which again is a very prudent and a positive step. For electronics industry specifically, I want to thank the Honorable Minister for rationalizing the import duties on IFPD. Is going to trigger domestic manufacturing. She has reduced the import duty on parts of open cell, which specifically for Dixon is going to be a big positive because they're setting up a display module plant. Also, rationalizing the duty structure for lithium-ion batteries is a positive for setting up the manufacturing ecosystem in this particular components. So on the whole, it looks very positive.
Mr. Lal, very good morning. Tamanna here. You know, so many things to unpack. Good afternoon, actually, now. So many things to unpack. The FDI and insurance has been increased. 4.8% is the fiscal deficit target for next year, lower than 4.9%. 4.4% has been penciled in for this year. So complete prudence there. Just on the Make in India push and some custom duties which will benefit you specifically, you spoke about that. The messaging on the Make in India push for manufacturing, is it what you had hoped for? Did you expect more? Should we have seen more?
So Tamanna, undoubtedly the first phase or the government policy framework has ensured that all devices, electronic devices being sold in India are manufactured in India. By the initiatives taken in this budget, particularly of rationalizing the import duties on IFPDs, on open cell parts, on batteries, is further going to deepen the manufacturing. We are also expecting a rollout of the PLI for component industry in the non-semiconductor space. We didn't expect it to be announced in the budget, but we are fairly confident, as per our understanding, that it's going to be rolled out by the government shortly. That is going to create a very deep component ecosystem in a non-semiconductor category, which will help in growing the industry, which presently is almost $150 billion. It has grown manifold in the last 4-5 years to almost $500 billion in the next 4-5 years. So we feel electronics industry is on the right path, and we want to thank the government and the Honorable Minister for this policy framework for triggering this growth.
Just one point from you, Mr. Lal, in terms of the demand push, and I know we spoke about briefly right on top, where tax slabs have come down, and the direction seems to be to push demand. Do you see an outlook for improved demand, especially in your segment, where demand has already been fairly robust?
So demand was normal. We would like to increase more because please appreciate the demand for consumer durable goods in very many countries, in our neighboring countries, is almost 5 to 6x what's there in India with a similar population levels. So demand has to go up more, which I feel strongly that with the rationalization and exemption on the income tax side for the middle class is definitely going to help. We would also request the government to rationalize the GST rates. I think some of the GST rates, particularly on things like televisions and other consumer durables, need to be brought down to 18% level, which presently are at 28% level. All this will trigger growth, is going to help in eliminating the unorganized market, and also it's going to increase the sale, which will compensate for the tax reduction on the revenue side for the government. So that's also another ask for us. GST, of course, was not a part of the budget, but we request the government to look at it in the forthcoming months.
Interesting. Whenever we are speaking to anyone from industry in whichever sector it is, the big request is from GST. More and more, all eyes are on GST for taxation, though there have been some custom duty tweaks right now. Just recapping some of the big things that are happening in various sectors. The number of life-saving drugs which will be totally exempt from custom duties has increased. 36 for cancer, 6 more on concessional duties. Big push for EV battery manufacturing and for 28 additional goods for mobile phone manufacturing as well. Big push for startups and of course fiscal prudence over there. The one big thing that stands out for you, Mihir?
I think as we discussed just in the opening, there was some expectation for something for the middle class that's come through, so that's a thumbs up, I would say. We still are not very clear about the capex number for FY26, but hopefully it should be around the vicinity of 10.5 to 11. That should be okay, I guess.
That should be okay, Nihir. Why so? Because then it's just about a 4-5% growth. Is it a budget that is saying that we're taking the tilt off capex full blown because the economy may not necessarily absorb, or is it the government saying that we've done enough, let the private sector now pick up the mantle?
A bit of both, because we've seen almost 25 to 30% CAGR for 5 years. So that probably rate is not sustainable. And we also saw that beyond a point, you're not able to push through that much also. So this year, while we had the budget, we were not able to push to the entire number. So maybe there's a physical limitation also to how much the government can do on its own. And probably it's time for the private sector to kick in. With incentives for taxpayers, a little bit of urban demand coming through. If capacity utilization in the systems comes through, then you probably will see the private sector also get into the investment phase.
Cross fingers for that, and we'll get more sectoral things going as well. But Mr. Sethia, just one quick thing on taxation before we get in Shanti Ekambaram and of course Hiral Johnson as well. But Mr. Sethia, somebody is asking about with the DTC in the offing, what do these limits that have been revised, what's the relevance? I mean, would some of these still hold? Is there any implication of the DTC coming in and the changes that have been made this time to the income tax limits?
Not at all. I don't think so. The new bill that she's talking about is primarily to bring about simplicity, more clarity, certainty, and so on. I don't think the tax thresholds and the rates that she has announced is likely to undergo any change whatsoever. That's coming in next week. And these proposals are effective from next year. I don't expect that the bill will do anything.
Okay, one quick follow-up, Mr. Sethia. Yes. Was there something that you were anticipating in terms of taxation with regards to foreign institutional investors, easing of any kind of processes or etc., which hasn't come about, or will it be in the fine print?
No, I think that will come in the fine print. But what I do feel is the customs changes are pretty good, both in terms of trying to promote exports, help industry, rationalize the structure, simplify and bring finality to some of the proceedings. So a lot of things there as well.
In fact, the FY26 capital expenditure has been set at 11.2 lakh crore. That's the number that has just come in. Exactly. Okay. So that's going to be interesting. That's a good number basis the estimates that you were putting in as well. So does this mean actually tell you that, yes, this is going to be a capital focused budget and the vote bank is going to be happy with this as per the schemes that have been announced as well?
Which vote bank is it?
Exactly. We're talking about,
because the market vote bank, which is no one cares for this vote.
But with this number and the tax slab, you're taking a push in terms of consumption to some extent. Yeah. So I think there is some bit of positivity, Tamanna, with regards to the middle class.
Yeah, no, of course. Before you answer that, I just want to get a view from Shanti Ekambaram. She's been waiting by, of course, Deputy Managing Director of Kotak Mahindra Bank. Ma'am, thank you so much for speaking with us here at NDTV Profit. And let's start with your first take on the budget. Capex number has just come in, as Hiral has told us. It's maybe better than what was expected. We didn't manage to spend all of the budgeted Capex last year. What do you think is the one big highlight in your view?
I think putting more money in the hands of middle class for consumption, savings and investment was expected and was delivered in my view. The fiscal prudence of 4.4 is very good. While we have to get into the details, one of the things we saw this year was that growth had slowed down because of the slowdown of capital expenditure by the government. So while the number that you talked about just now says 11 lakhs, how much they spend and how much they upfront the spending is a direct impact on growth. What ails us right now is the economy has slowed down and we need to pump prime the growth of the economy. I think the budgets have snippets of how to do it, whether it's agriculture, MSME, putting more hands in hands of people. But in my mind, fiscal prudence and putting money in the hand of the middle class, to me, are the two things that really stood out amongst the many small nuggets that were there in the budget.
Okay, Mr. Ekambaram, the thing that we are grappling with is, and good afternoon, Neeraj here, is that one, there is a lot of change made to taxation, as you said, and on the revised base of 10.18, an FY26 capex number of 11.2 lakh crores, which has just come in now, suggests that near circa 10% growth. So that and no big and fiscal consolidation attained too as well. In some sense, the three big things, the troika of the three big things that people were watching out for, seem to have been ticked partially, if not fully.
So, which is what I said. They have committed to 11 lakhs capex, but I think it needs to be upfront. Last year, one of the issues, Neeraj, was that it was back-ended, of course, due to elections and many other factors. Second, by doing 11 lakh crores, yet increasing, maintaining fiscal prudence is a question that's not fully answered because the tax receipts, there's a reduction of 1 lakh crores by way of giving, the middle class the exemption up to 12 lakhs. But there is also the increase in tax collection significantly by about close to 7 or 10%. So I think we need to do the math, the secret behind the numbers. But right now at a macro level, higher capex, lower fiscal deficit, more shops for the middle class, and keeping it is a little bit of a mystery that we have to work out. But if it happens, I think that's the best thing for the economy. I think we have to address growth. Fiscal done, monetary will probably follow, but I think we have to address growth because you saw the economic survey. 6.3 to 6.8 is far lower than what India needs to grow, which is 7.5 to 8%.
Mr. Ekambaram, Hiral on this side, taking both these aspects into consideration, how are you expecting then the RBI to move this week, next week on Friday, because that's the other aspect on the rate cut cycle that everyone is watching out for?
So what is very important pre to a rate cut is really liquidity. And if you saw that the markets have been in a seizure on liquidity. But I think last week, Reserve Bank came with a slew of measures that gave a ton of liquidity to the market. In my view, that's a precursor to a rate cut in the February policy. And I personally expect a 25 basis points rate cut. I think from an inflation standpoint, we are not yet there. But I think it's always a balance between growth and inflation. Yes, inflation has not reached a sustainable 4%, but I think growth has slipped quite a lot. So my own expectation is a 25 basis points rate cut. But more importantly, we will be looking for the narrative on how liquidity can be provided because it is important for credit flow to the various sectors. It's important for deposit flow to the banks. And it's important for a good market to find the right rates.
I'm just wondering, Mr. Ekambaram, you said growth is the push that is required. From the capex figure that we have, do you think that there is enough boost for that growth? Because yes, consumption on one end, middle class, sounds good, feels great, superb headline tomorrow. But the growth issue, do you think that has been addressed adequately?
I don't think just spending by the government is going to only spending by the government will give us the growth. I think we have to stimulate private sector. And I think 2-3 things that they talked about in the budget, ease of doing business, right? Whether it's, facilitating exports, whether it is facilitating manufacture in India, whether it is boosting the MSME sector to invest more, or bringing productivity and gains in agriculture sector. It cannot just be achieved by only the government spending capex. They have to stimulate the economy across various sectors, and investment from the private sector has to follow. Second, foreign capital investments across segments. For example, the insurance sector raising the stake to 100%, provided they invest the premium in India, was surprising. At least I did not expect it. So I think it is important to stimulate. So the rest of what they talked about need to happen. Very important, ease of doing business and amongst the various segments I talked.
Segambaram for joining us. So execution is going to be key from here on as well across parameters. But let's actually head across to Alex because he's going to get us the breakup with regards to the FM's big budget bonanza that has come in for the middle class. I think from what I read, it's going to be the biggest income tax relief since 1997. That's what the word that we're picking up. Alex, break it up for us.
Well, I don't know if I'll go that far back, but certainly if you think about it, and I've been working for about 14, 15 years, right? So if you go back to about 2010 or thereabouts, 10 lakh rupees was the threshold for the highest tax slab. And that was, at that point, thought to be a decent amount of money to be earning every year. And above that, it was taxed at 30%. Now take a look at inflation. If you assume that over the last 15 years, we've had 7% or thereabouts inflation, then the value of that 10 lakh is approximately 24, 25 lakh at this juncture. The slab changes that have been done today acknowledge the impact of inflation on the pocket of the middle class, and it's been changed to give some relief. And a relief is maybe an understatement. Take a look at the major announcement. Of course, these are how the new tax slabs look. You'll be forgiven for not knowing exactly what it stood at last year because I'll remind you, right? So 0 to 3 lakh was the lowest tax slab that is raised to 0 to 4 lakh. It's 0%. 3 to 7 was the earlier slab. It is now standing at 4 to 8%, which is 5%. 8 to 12 goes up to 10%. 12 to 16 goes up to 15%. 16 to 20 is 20%. 20 to 24 is 25%. And above 24 is 30%. In the previous new tax regime, any income above 15 lakh rupees was taxed at 30%. So already there's a huge relief that is being provided. What is more, the earlier rebate was on income up to 7 lakh rupees. What that meant is that if you earned up to 7 lakh rupees in taxable income, you would not effectively be paying any tax. That has now been raised to 12 lakh rupees in the new tax regime, which means that if you are earning a taxable income of up to 1 lakh rupees per month, you're not going to be paying any tax in the form of income tax. The clarification that is going to be required is going to be what she meant, what the finance minister meant about the special income. She specified about capital gains. And the interpretation currently is that if you earn even less than 12 lakh rupees, but if you have an element of capital gains in that total income that you earn in the year, then you will not be able to claim that rebate and you will have to pay basis the slabs. This is something that has to be clarified.
Okay, Alex, thanks so much for that. But I want to draw the attention back to markets because they are, well, if not taking it on the chin, certainly languishing. IT is down 1.45%, but I think the index which deserves a special mention is BSE Cap Goods Index. Capital goods is being taken to the cleaners. From an ABB to a Siemens to a BEL, L&T, all of them are getting a punishment because the street seems to be disappointed. For now, with the capex numbers, 10.18 lakh crores for FY25, and on top, on that base, 11.2. But if you look at the earlier estimates of nearly 11 lakh crores, there is almost no growth in capex. Mihir Vora, you are showing me a chart around capital expenditure, but clearly the street right now is very, very disappointed with the capex number that has come out.
Yeah, I think it's a bit of a knee-jerk reaction, I would say, considering that the base was already low. You know, you are seeing a 10% increase in the budget, and I think this combined with the fact that you are probably providing almost 1 lakh crores of subsidies to the taxpayer is not a bad outcome, frankly, as we discussed in the morning.
But
it's going to be a balancing act.
For the capital-intensive industry or
Absolutely,
sector,
yeah.
is this a disappointment? The valuations that they are trading at, so on and so forth?
See, this has been one of the sharpest hit sectors in any case in the last 3 months or so, right, from the peak.
Right.
So I don't think too much was being built into the prices in any case. Probably in the last couple of days we saw this uptick, and that's what's being corrected.
Okay, whole host of speakers joining in right now for their view. We are speaking to Mayank Shah from Parle. Great time to get a view on consumption. We're joined by KK Mistry. Want to get his view very quickly on what we can expect as well. We have the Macquarie view on markets as well. So we'll get to all of it one by one. Sandeep Bhatia also joins in. Sandeep, great to speak with you today as well. So Sandeep Bhatia, Mayank Shah and Keki Mistry joining us for this leg of the conversation. And, I actually, Mayank, I should see the biggest smile on your face. More people have money to buy your biscuits. So, which is why let me start with your take first.
Yeah, so no, absolutely. So that's getting reflected in the FMCG index as we speak.
Yeah.
But yeah, I think this was much anticipated and much expected, and I think full marks to the finance minister for doing it. This is going to really spur demand for consumer goods, and looking at the kind of challenges that most consumer goods were facing in last almost about 2-3 years, this is something that's going to be of a great help to all the consumer goods company. I think 12 lakh rupees effectively, along with standard deduction 12.75 lakh rupees of tax-free income. I think is a big move and a very bold move by finance minister. This is definitely going to result into spur in or a jump in demand of consumer goods. That's one. As if that was not enough, I think almost every expectation that most consumer good companies had, right from accelerating rural demand. So I mean, budget was all about acceleration in growth, and that's what FM has lived up to when she talked about Pradhan Mantri Dhan Dhanya Yojana, where she's talking about 100 districts being focused on for agricultural initiatives, or even urban infrastructure, where she talked about the second engine of growth, MSMEs, and increasing their annual turnover limit by 2.5 and 2x, so as that they can grow. That's going to generate more employment. So that's another thing. I think both put together, I'm talking about the agri initiative, first engine of growth, and the second MSME. That's going to generate enough and more employment in the rural and urban India, which is going to have a direct impact on the demand. So having done that, I think, the other important and salient things that one needs to mention about the kind of initiatives taken by FM are even the Urban Challenge Fund, where they are talking about driving transformation of cities. So all this spends on infrastructure, urban as well as rural, are going to generate jobs.
Cross fingers, Mr. Shah. Sorry, just getting in other panelists in the conversation as well. But this is great to get an opening thought from you. As Tamanna said, you would be a happy man. Mr. Mistry, bond markets would be happy as well, I presume. Don't know much about the capex intensive industries because they are not very happy with the capex growth. Your initial thoughts, sir? Fiscal deficit, capex, personal tax, what have you?
All right. I think firstly, the budget is very broad-based. It's covered so many areas and so many facets of the economy which are critical. You have focused on agriculture, you have focused on MSME, you have focused on education, transport, tourism, energy, export, all of that. And most important, as the earlier speaker said, is the fact that with the lowering of the tax rates and the increase in the minimum exemption limit, clearly it will spur consumption. So what was it we were looking for in the budget? I was looking at for 3 or 4 things. First thing I was looking for was consumption, which very clearly has been met. I think it's done. The consumption boost in the economy is a huge boost that we will see in the days to come. Second, I was looking at job creation, and I think there are enough measures in the budget to facilitate job creation, whether it's in the MSME sector, whether it's in the rural sector, or in various other sectors of the economy. So these were the 2 broad things that we were looking at. And I think both these have been met. Growth, I think we are still too premature to say that, you mentioned that some of the infra companies, the stocks are down. I think we need to understand the budget a little more before saying that, before commenting on that. I think there is growth, there will be growth, because when you reduce the tax rates, you automatically increase consumption. When you increase consumption, the manufacturer needs to produce more to satisfy that demand, which automatically creates more jobs and creates growth in the economy. So we need to understand a little better. I also think it is growth oriented.
Sure, Mr. Mistry, I appreciate that. Just saying that somehow the street anticipated, went for the headline numbers. And on that front, it seems to be disappointed because the market is giving that verdict. Maybe it's a false alarm. And as our guest Mihir Vora was saying, the index has corrected so much already, maybe not too much of downside left here.
Absolutely. And I think in terms of the capex number, the number that we're tracking, probably the markets are looking at it in a positive way, but there is a correction in the market, so we cannot rule that out, Neeraj, as you're saying. But let's also take this question with Sandeep Bhatia. Sandeep, good afternoon. Your first cut in terms of how are you looking at the budget, with the numbers that have come in, specifically with the fiscal deficit, and in turn, if you have to look at the capex, because the markets are really not reading it well now.
As the previous two speakers have said, I think this is a budget which is balancing many things. Focusing on one number is a wrong way to look at and evaluate any budget. Definitely not this one. I think the patient is taking the medicine which the doctor ordered. The patient needed a consumption boost, and that's what is getting administered, and that's a good thing. Capex is definitely not. There's no space for giving a capex boost and a consumption boost in the budget. So simple as that. You have to make a choice, and I think the doctor has made a right choice. So that's where it is. I think on the whole, if the market is falling, well, market and economy are correlated over long periods of time, and in the near term, anything can happen in the market. A lot of things, the kind of run up we have had, that itself warrants a correction, in my view, for the stock indices, and that's what's happening. And that's also actually, in the end, healthy for the markets. If market price is correct, that's also, in the end, definitely a good thing.
Sandeep, while we were listening to your answer here, our studio guests are saying our market is throwing a tantrum. Because
that's what Mr. Mistry said as well, by the way.
Yeah, it was something which Mr. K.K. Mistry said as well, just from the point of view that, there was this ask to boost consumption that has come in. There is a lot of clarity in direction, PLI schemes, manufacturing, just that broad direction is in place. What is your take on this, Sandeep? Was too much expected, or is there not enough to really trigger that growth that was becoming a concern?
The growth concerns have been there for good reason, and I would also moderate everyone's expectations that just because of this tax cut, that doesn't mean growth concerns will go away immediately overnight. People are not going to rush out and spend to buy cars or biscuits or anything else just because there's a tax cut. People need to earn the income and then do the spending. So in the end, markets always are like a spoiled brat. If you give them one thing, they'll say, I want something more in addition to what you just gave me. I think this is what can be done, and what could have been done has been done. So I would.
Okay, Mr. Mistry. That's it. Yeah, no, fair call, Sandeep, and points well taken. Mr. Mistry, a couple of questions to you before we thank you. One of them is on the fisc deficit glide path, and the fact that the belief was that there needs to be a boost given to growth, and the FM seems to have chosen the consumption route to do that, as you said. Could the thought process also be that we've gone out and tried the capex route, fronting up the capex, waiting for the private sector to come in, hasn't happened, consumption has suffered in that interim, might as well try and give a boost to consumption, because such a kind of tax move has not been done, as Mr. Setha said, in a really long time.
No, I agree. I completely agree. I think the growth will come, but I think Sandeep said the growth will come with maybe a little bit of a lag, because when you reduce the tax rates, you increase consumption. When you increase consumption, you automatically will result in more demand, and more demand will result in more growth, but it will come with a lag of maybe a couple of quarters. So growth focus is very much there, and the reduction in the fiscal deficit is, in my view, a good sign. The target was 4.9. Now we are talking of 4.8 for this year and 4.4 for next year, as compared to the 4.5 that we had previously. So I think good. It will help the bond market, number one. Number two, it could help India in the rating also at some point of time. The rating outlook could, obviously these things would help towards the rating outlook. And I think if we can continue the glide towards fiscal consolidation, then I think it's a good measure. Tax collections have been very buoyant. Tax collection target is also fairly strong, in the sense that there is a 10% increase in the tax target for next year, despite the fact that there is almost 1 lakh crores lost because of the reduction in the increase in the exemption limit.
Mr. Mistry, just on the point about increasing FDI in insurance, Your take on how it will impact the sector? Do you think there'll be any takers from the Indian insurance companies right now for that additional FDI coming in? Is it more signaling than an actual impact that we could see in this space?
Initially, it is signaling. It may not directly result in too many companies coming and increasing their stake. But having said that, in the long term, it's a good signal to give to the market. I wish they could also do it for the banking sector, because that would give a direct benefit to the capital markets. Because if you look at the MSCI index, which is where most of these passive funds invest from, the MSCI index takes into account the fact that the shareholding by foreigners in bank is capped at 74%. If that is increased to 100%, then automatically our weightage in the index will go up. And if that goes up, that brings in more foreign money into India, without in any way affecting ownership, because the ownership of banks is very strictly controlled by RBI.
Mr. Mistry, we'll let you go on that note. Thank you so much for talking to us and giving us your sense. And, we'll come to Mayank Shah and of course, Sandeep Bhatia as well in a moment from now. But Mr. Sehta and Mihir with us. And Mihir, a word on insurance. You come from an insurance background. One is, of course, the limits. Who would go out and sell 100%? So is there a benefit of increasing the FDI limit from 75 to 100 within the current large insurance companies? And part two, sorry, just a personal finance question there. Since the exemption is now at 12 lakhs, does it at the margin reduce the attractiveness of insurance for tax saving purposes for that bucket? And is that the reason why the stocks are down?
I guess so. But on the first question, you're right. There's not many companies which are going to immediately sell out to foreigners, but as Mr. Mistry said, it's more of a signaling thing that we are open for business. We are getting more open as a economy, and I think a couple of years ago, anyway, from the exemptions point of view, you saw some reductions in exemptions for insurance in any case, especially on the ULIP side. So I think this is more of a continuation of the same. So, but we saw that the industry growth really did not falter. So ultimately, products which are being sold are being sold, and I don't think apart from an immediate blip, there should be a big impact to the sector per se.
Okay. Markets right now down, about Nifty about 0.5% down. Nifty IT really taking a knock in the last few minutes. Let's just pull up the intraday of that index as well, about 1.5% down. Those pain points coming in now. I mean, you could call the market a spoiled brat. You could say whatever you want, but the fact is, market's not reacting too positively. What's the view right now, Sandeep Bhatia? Are there opportunities that you can see based on this budget to start shoring up positions from an equity perspective? Or would you wait and see what really comes at the end of corporate season? Because once the budget buzz dies down, we're back to brass tacks.
I think we are always back to brass tacks every day of the week. So I think essentially what my base case assumption is that we see consolidation of the fisc, which has happened. We will see pressure on the rupee. I think that's not being discussed in this on this panel. I would expect continued pressure on the rupee, especially if the tariffs go up globally. One of the ways which countries will move to counter US tariffs is to depreciate their currencies against that. And similarly, even if there are no high tariffs against India, to meet tariff on competing countries, Indian rupee will also need to depreciate. In that, I think exporters will do good, and even as I mentioned, discretionary consumption, Maruti looks good in the near term, especially because there's a pay commission for central government employees and state government employees, which will kick in next year. So discretionary consumption, exporting businesses definitely look good in the near term. The other thing is private banks. Indian fisc remains in a healthy state. And private banks, some of them are very cheap now. And also the overhang of excessive ownership by FIIs have gone away. So to that extent, private banks look good.
Okay.
So Sandeep, let's look at the defense number as well. The FY26 capital outgo at 1.8 lakh crores. If you pull up all the companies as well, don't seem to be taking it really well. How are you looking at it?
I saw a paper which discusses that even the defense spending is lower than the outgo. It's unfortunate that our decision-making and bureaucracy cannot spend the money which is given to them for defense. Our geopolitical situation is very difficult. across all most of our land bordering countries. I would think, therefore, I would focus on using the money, spend rather than looking at whether the money has got allocated or not, because almost, I think, out of 10 years, maybe 1 or 2 years, the money was left unspent, what was allocated. So that's good. I think the US will also put pressure on India to buy US equipment. We'll have to see what is on offer and what is needed by our forces. And in any way, these things have long-term impact. Even if you make an order today, we know for a long time that even our our aircrafts which are coming from HAL have been behind schedule. So all these are good numbers to talk on a day when the budget is announced. But life is, as you said, back to brass tacks.
Quick word from Mayank, yeah.
Just before you go to Mayank, just wanted to go this clarification because there's a lot of confusion around the defense allocation.
Yeah.
So FY26 allocation is at 1.8 trillion versus 1.59 for FY25, and that 1.59 is been revised, and FY25 has been revised downwards from 1.72 to 1.59. But at 1.8 for FY26, it's anyways higher than the budgeted earlier number given and the revised budgeted as well. So both.
Yeah.
So FY26 is anyways not a bad number.
So it's the same situation as the overall capex.
Yeah, exactly.
Whereas you are seeing a 10% growth on the revised lower
number.
estimates for FY25.
Yes.
But not so much of a growth from the original budget
5%.
So that would be from 11.1 trillion to 11.2. So that is just absolutely
defense
same.
too,
But defense is still okay. We should see what some of those defense stocks are also doing. On the consumption point, Swiggy up, Zomato up. I just wanted to get this point from you, Mayank, how much of a boost do you think consumption will make to the prime question of private capex? Now, for example, if you see enough of a demand boost, does it encourage you as a large company to expand more, spend more? Why has that private capex not been coming in?
As I shared earlier also, I think last 3 years were challenging. And the biggest challenge that most consumer companies faced was inflation, input material inflation. And that was the reason why there was impact on demand. Initially, we saw a slowdown in rural demand. Post that, since last few months, we are seeing, sluggish urban demand. Now, once demand goes up, there definitely would be expansion that would be happening. So I think, I would agree with some of the panelists, who earlier said that markets are throwing tantrums, especially when it comes to capital goods. Capital goods basically are produced means of production. Today, if we are talking about increase in demand in consumer goods, there definitely is going to be an impact that's going to be there on the capital goods as well. May not be on all the capital good companies, but yeah, some of them or most of them would be manufacturing, machineries or, capital goods to produce consumer goods. So I'm saying, in long run, it's going to be beneficial. When you're spurring consumer demand, I think, net, we're talking about, impact that's going to happen across, broad-based entire economy. That wouldn't be selective to, let's say, a particular sector or a particular category.
Okay, Mayank, thank you so much for joining in today. Sandeep Bhatia, thank you so much for your time. I would say not half bad. I mean, markets are taking some time to warm up to what the finance minister is saying. But truth be told, the consumption story has got a big boost this morning. I'm just looking at some of the leaders in the broader markets. A Campus Active, about 13.5% up, obviously because of that footwear scheme that has been announced. A Bikaji Foods, I want to pull up and see what a Zomato and a Swiggy are also doing. A Trent moving there, a Blue Star moving there, disposable income good for all of these companies, and you can see that sharp spike there. We're taking a very short break, but we'll be right back with our next set of speakers and give you a more detailed analysis of the budget fine print. What exactly are the details coming in of where allocation has been made? This is the day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense,
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims?
Welcome back. The budget bonanza has definitely come in for anyone who pays taxes. Maybe those who are trading in the markets right now are waiting to see the silver lining, but for taxpayers, this has been everything you could expect. Some of the best tax relief in decades that has come in. At last count, we saw from 1997 onwards. So no tax till 12 lakh rupees of income and then onwards. The Nifty now recovering from its lows of the day. But what you're seeing working in the market right now is completely reflecting this. The push to consumption. The street asked for it. Every economist, every company, every businessman asked for it, and it has come. Where you're seeing a sharp focus on consumption, which is why you see today a Godrej Consumer, an Avenue Supermart, a Blue Star, all of this working. Hiral and Neeraj, this is clearly a push for consumers. But the other thing, Tamanna, and I think, you know, before the budget announcement happened, we were saying that maybe Feb 7 is more important, right? Does the 4.8 and 4.4 number set the stage for a rate cut next week? Because the government is telling the RBI that we are walking the path of fiscal consolidation. Now, can you give that little push? Because the RBI has already done that in a little bit, right? So is that the big thing? And I think we'll go to Lakshmi here as well. But me, final set of questions to you. Bond markets would be a happy place right now. I'm just trying to understand from an investor's perspective, right? Large cap, mid cap versus small cap. Is there a change now that you would do? And would the fixed income funds come into equation currently?
I think the borrowing number is not all right. So it's broadly in line with what we were expecting. So I think from the bond market point of view, it's a business as usual budget. People are expecting 4.5. 4.4 is an even better number. And I think we are back to business as usual, I would say. The more the budget remains a non-event, the better for the economy, right?
This is hardly a non-event. Hardly. Here, I wouldn't say it's a non-event. Mihir, there were cheers when she was announcing that. Like there were cheers going up. Yeah.
No, but no big surprises, negative surprises. That makes the budget a non-event, thankfully, from that perspective.
And remember, we started by saying, you know, in this budget, no bad news will be good news.
Yeah.
But there is some good news. There is some good news. But why is the market not seeing it then?
Because I think the markets are reacting the same way they've been reacting to earnings. You know, bad news, you're beaten down. Good news, you don't really move that much. I think that's what we are following even with the budget commentary, I think, Tamanna.
Yeah, Lakshmi Iyer with us this morning. I keep saying morning, afternoon. It's 1 o'clock now. The budget day just goes by in a whiz. CEO, Investments and Strategy, Kotak Alternate Asset Management. Lakshmi, I know you have the right dialogue and the right tune ready for what you've seen in the budget, but I will leave it to you, your first comment on what you've made of the budget math and the announcements today. Lakshmi, can you hear me?
Yeah, I can hear you now.
Okay, you can. Okay, so I was saying, I know you have exactly the right way to encapsulate what we've seen in the budget. I don't know if it's going to be a dialogue, a tune, or a song, but what have you made of this time's budget?
So I don't know of any dialogue, but what I could think of is that market wanted both Karan and Arjun, and they said Karan Arjun aayenge, and Karan Arjun meant capex boost and consumption growth both. As of now, it seems to be more tilted towards the consumption boost, which is, through the direct tax rationalization, or for that matter, self-occupied property, the annual value that you declare from 1 to 2, I think all of that clearly means that there is more, propelling the discretionary consumption boost, which is definitely good news from a market standpoint. So yeah, I think, and they've tried to kind of, get in quite a few sectors, whether it's tourism, whether it's hotel industry, of course, healthcare, pharma. I think all of that put together, seems to be that the weekend is going to be quite active.
Lakshmi, the weekend is going to be quite active, but what does this tell you with regards to the coming Friday when we have the RBI coming in as well? Has this actually set the tone in terms of what they could do?
Well, I would say the RBI already kind of did a quasi-easing by doing some liquidity measures early last week. And there probably could be more to follow. So I think, and of course, the budget living or, staying within the fiscal path of consolidation or discipline is another positive check the box. Are these necessary and sufficient conditions to probably go in for a rate cut? I still would probably do like a toss of a coin, quite difficult, and with a tad higher probability saying that maybe that, instead of a Feb easing, can you push it to an April easing? Is it going to move the needle materially? Well, probably not, because we have to look at what's happening globally also. Of course, domestically, things also are, kind of falling in line, but globally, things are not completely in our control yet.
Lakshmi, thank you so much for joining in. Really appreciate your time. And take a moment to thank our budget think tank, Mr. Pranav Sehta, Mr. Mir Vora. Thank you so much, gentlemen, for joining in today and giving us your thoughts. Really appreciate your time. Okay, we have a special guest with us, Dr. Anish Shah, Group CEO and Managing Director of Mahindra Group, joins us right now on the show. Dr. Shah, thanks so much for joining in. It's a budget that has kind of played the balancing act on 2 or 3 counts. But most importantly, if the cheer in our newsroom is anything to go by, there is the big bonanza given to taxpayers. How do you see this?
Viewers, good afternoon. We see 3 major themes of this budget. One is the demand stimulus, which was much needed. And the bonanza to taxpayers is something that should translate into expenditure. And that's going to be a positive for increasing capacity utilization for companies and thereby private sector capex, which is one area that has been in focus for quite some time now. The second big theme is Make in India. And this is, again, essential for an economy that has to grow many multiples over the next few years. And here we've got many different incentives around capital goods imports being cheaper, addressing the inverted duty structure in most cases, ease of doing business. And these are all factors that will go a long way in ensuring that the cost of manufacturing in India becomes lower and India becomes more competitive in the world. There is obviously a lot more to be done on this front, but these are steps very much in the right direction. And the third major theme is inclusive development, with a focus on agri, on MSMEs, on skilling. These are all factors and ecosystems that are required for both manufacturing and services, and obviously the agri sector as well. So in all, this is a budget that has balanced various factors, in our view, very well, and continues to drive the strong fundamentals of the economy and hopefully takes us out of some of the speed bumps we've seen in the recent past.
Anish, Hiral on this side, you mentioned about the demand stimulus. To add to that, we've already seen a tax hike that came in terms of, second-hand cars, which was also a booster dose for OEMs. How are you looking at this for the auto sector then?
I think the auto sector still has a long way to go from a growth standpoint. So I would look at more fundamentals that help us in the long run. The focus on EV is very positive right now. The measures that the government has put in place have helped take three-wheeler penetration in EV from 0 to 25%, and it will go to 100% in the next 3 to 5 years. Four-wheelers, we've just started the journey. We are at 1.5 to 2% right now. But again, the measures the government has taken will help us take that penetration to 30% or even higher. So we're looking more at long-term. Some of the shorter-term measures around used cars are really not a very significant impact. What is of a greater impact is, as I said earlier, measures that help us manufacture in India for the world, because we are in a position to do that now.
Dr. Shah, Tamanna here, and this is just such a interesting budget to look at. Every time we say that non-event, this time there is a real push towards consumption. And I know you've talked about how you see it pairing out. Do you think that if there is more disposable income in the hands of people with the push that has been given to EV in terms of battery, custom duties, etc., that the real pivot for the industry, for the auto industry on EV comes now after this budget?
I think this is just one factor, Tamanna, that adds to everything else. Because EV starts with a product that is a wow product, where customers look at it and say, I really want this. We have to address the range anxiety, which again, we've done with our born electric products. We've got to ensure that there is a reasonable ecosystem for charging, which is coming up very rapidly now. And the consumption boost will help not just the auto industry, but many industries. So it's a clear positive for the economy.